Hello. So this pen is not connected. Okay, fine.
Hi guys, we have exciting news today. If you look at ArivuPro, we have always been innovating, right from our subscription models to on-demand exams, giving recorded classes. We have been friend of innovation, and today we are very happy to launch one such a very innovative program, and we are calling it ArivuPro 1. So what is this ArivuPro 1? ArivuPro 1 is nothing but 10 certifications in one program. Yes, you heard me right. You can earn 10 certification by doing this one program. Now you can do your BCom, CA, CS, CMA, ACCA with exemptions, CMA USA, EA, CIA, FRM, skill-based course certifications. All these 10 certifications ArivuPro 1 is going to offer you. Now, by choosing ArivuPro 1, you can get to choose all these courses. If you want to do CA, CS, all the courses you want to do, you can do it. It is not that if you do CA, you cannot do CS. That's the speciality of this ArivuPro 1. We are launching a new program, a very innovative program, a pain point which we want to address. Because students join some normal BCom, they go outside for professional courses, or sometimes they offer, they join BCom with CA, and if they get stuck, they are not able to migrate to another program. We want to address this problem. That's where we introduce ArivuPro 1. In this program, you are not confined by one professional course. You have the choice to do any 10 professional courses, right? You can do any of these professional courses or all the 10 professional courses, you can do it. The choice is with you. You can do it from Chennai, you can do it from Coimbatore, you can do it from Bangalore, or you can do it online from all over India. This is the course. For more details, right, we will be releasing more videos on this course. You can call my team and they'll be more than happy to explain this course. Spread the word. Those who are looking for undergrad programs with professional courses, ArivuPro 1 is the choice. One program, 10 certifications, infinite opportunities. See you guys. Bye-bye. Hi guys, we have exciting news today. If you look at ArivuPro, we have always been innovating, right from our subscription models to on-demand exams, giving recorded classes. We have been friend of innovation, and today we are very happy to launch one such a very innovative program, and we are calling it ArivuPro 1. So what is this ArivuPro 1? ArivuPro 1 is nothing but 10 certifications in one program. Yes, you heard me right. You can earn 10 certification by doing this one program. Now you can do your BCom, CA, CS, CMA, ACCA with exemptions, CMA USA, EA, CIA, FRM, skill-based course certifications. All these 10 certifications, ArivuPro 1 is going to offer you. Now, by choosing ArivuPro 1, you can get to choose all these courses. If you want to do CA, CS, all the courses you want to do, you can do it. It is not that if you do CA, you cannot do CS. That's the speciality of this ArivuPro 1. We are launching a new program, a very innovative program, a pain point which we want to address. Because students join some normal BCom, they go outside for professional courses, or sometimes they offer, they join BCom with CA, and if they get stuck, they are not able to migrate to another program. We want to address this problem. That's where we introduce ArivuPro 1. In this program, you are not confined by one professional course. You have the choice to do any 10 professional courses, right? You can do any of these professional courses or all the 10 professional courses, you can do it. The choice is with you. You can do it from Chennai, you can do it from Coimbatore, you can do it from Bangalore, or you can do it online from all over India. This is the course. For more details, right, we will be releasing more videos on this course. You can call my team and they'll be more than happy to explain this course. Spread the word. Those who are looking for undergrad programs with professional courses, ArivuPro 1 is the choice. One program, 10 certifications, infinite opportunities. See you guys. Bye-bye. Hi guys, we have exciting news today. If you look at ArivuPro, we have always been innovating, right from our subscription models to on-demand exams, giving recorded classes. We have been front of innovation, and today we are very happy to launch one such a very innovative program, and we are calling it ArivuPro 1. So what is this ArivuPro 1? ArivuPro 1 is nothing but 10 certifications in one program. Yes, you heard me right. You can earn 10 certification by doing this one program. Now you can do your BCom, CA, CS, CMA, ACCA with exemptions, CMA USA, EA, CIA, FRM, skill-based course certifications. All these 10 certifications, ArivuPro 1 is going to offer you. Now, by choosing ArivuPro 1, you can get to choose all these courses. If you want to do CA, CS, all the courses you want to do, you can do it. It is not that if you do CA, you cannot do CS. That's the speciality of this ArivuPro 1. We are launching a new program, a very innovative program, a pain point which we want to address. Because students join some normal BCom, they go outside for professional courses, or sometimes they offer, they join BCom with CA, and if they get stuck, they are not able to migrate to another program. We want to address this problem. That's where we introduce ArivuPro 1. In this program, you are not confined by one professional course. You have the choice to do any 10 professional courses, right? You can do any of these professional courses or all the 10 professional courses, you can do it. The choice is with you. You can do it from Chennai, you can do it from Coimbatore, you can do it from Bangalore, or you can do it online from all over India. This is the course. For more details, right, we will be releasing more videos on this course. You can call my team and they'll be more than happy to explain this course. Spread the word. Those who are looking for undergrad programs with professional courses, ArivuPro 1 is the choice. One program, 10 certifications, infinite opportunities. See you guys. Bye-bye. Hi guys, we have exciting news today. If you look at ArivuPro, we have always been innovating, right from our subscription models to on-demand exams, giving recorded classes. We have been friend of innovation, and today we are very happy to launch one such a very innovative program, and we are calling it ArivuPro 1. So what is this ArivuPro 1? ArivuPro 1 is nothing but 10 certifications in one program. Yes, you heard me right. You can earn 10 certification by doing this one program. Now you can do your BCom, CA, CS, CMA, ACCA with exemptions, CMA USA, EA, CIA, FRM, skill-based course certifications. All these 10 certifications ArivuPro 1 is going to offer you. Now, by choosing ArivuPro 1, you can get to choose all these courses. If you want to do CA, CS, all the courses you want to do, you can do it. It is not that if you do CA, you cannot do CS. That's the speciality of this ArivuPro 1. We are launching a new program, a very innovative program, a pain point which we want to address. Because students join some normal BCom, they go outside for professional courses, or sometimes they offer, they join BCom with CA, and if they get stuck, they are not able to migrate to another program. We want to address this problem. That's where we introduce ArivuPro 1. In this program, you are not confined by one professional course. You have the choice to do any 10 professional courses, right? You can do any of these professional courses or all the 10 professional courses, you can do it. The choice is with you. You can do it from Chennai, you can do it from Coimbatore, you can do it from Bangalore, or you can do it online from all over India. This is the course. For more details, right, we will be releasing more videos on this course. You can call my team and they will be more than happy to explain this course. Spread the word. Those who are looking for undergrad programs with professional courses, ArivuPro 1 is the choice. One program, 10 certifications, infinite opportunities. See you guys.
Hello everyone, this is Naina. I hope I'm audible. So today we'll be doing a marathon, a very quick marathon for management accounting, which is F2, the ACCA paper, right? So now this particular marathon that we'll be doing will be a lot of theory that I'm going to tell you right now. So there's a lot of calculation obviously in management accounting, but we're going to be sticking with mostly theory. And for calculation, I'll tell you what formulas will be given, what formulas you need to memorize, and how you will do that. We'll just get a short idea of that, right? But mainly it's going to be theory. Understood? Now, this is going to cover everything, right? So whatever is there in all of your study hub materials, all the remaining exam kit, study text of any company, right? All of it will be included here. Okay, but along with that, this is not sufficient for you to go and if you want to get full marks, that is, but this is sufficient for you if you need to pass. Obviously, along with this, you will need to do your calculation as well, because that comes as a majority part again, right? So it depends on your luck. Like I would say 60-40, 40-60 theory calculation, any way it could go, right? But there are certain things that they will not be asking, which I will let you know, right? Some things which are very, very evident that is ACCA's favorite topic, they will ask that, and I will let you know what those are and what are not the topics that are frequently tested. Okay, now management accounting is a paper. So we have in ACCA, we have in the foundation level F1, F2 and F3. Okay, so BT, management accounting and financial accounting, right? Now this is a lot of calculation, 80 to 90% calculation, making statements, remembering the standards, all of this. This is completely theory. Management accounting is one thing that balances both theory and calculation. Okay, so that's why it could be 60-40, 40-60, like I said. Okay, now already we need to know that financial accounting is something that is related to outsiders and management accounting is related to people within the company. Okay, so we'll be dealing with a lot of internal stakeholders in this particular paper, right? Now, this was the basic idea that you needed to know. Now, before we start off with the paper itself, we will go through the exam pattern. Okay. Under exam pattern, we have two sections, section A and section B. Section A involves answering 35 questions. Each question is going to be of 2 marks, so 70 marks. Right now, section B is going to have 3 questions. Now, these are not MCQs, these are MCQs. Okay, now this could come under the form of true and false. It could come under the option of picking 2 options out of A, B, C, D, picking 1 option out of A, B, C, D, or match the following sort of answer, drop down list kind of options. Any of these could be tested, right? But in section B, this is called MTQs, multitask questions. Now, multitask questions is nothing but in one particular, now each question will be of 10 marks. That doesn't mean it's a big question of 10 marks. It'll be subdivided. So you can score this 1 mark by itself. Okay. So it's not like if you get one question wrong, the whole 10 marks will collapse. Not like that. Right, so it is 10 marks, but then it can be divided between 1 mark, 2 mark, 1.5 mark, anything like this. Okay, each task within the 10 marker will be of 2 marks, 3 marks, any of these. Got it? Now this will give us 30 marks, so total 100 marks, and you will get 2 hours to write this particular paper. Okay, now this is going to be the exam pattern. Now I'll explain to you what we'll be getting in management accounting and what is the exam paper pattern. Okay, now without wasting a lot of time, because I need to complete this really quickly so that it will be like a short video for you, and then you guys can not lose confidence in between, not lose interest in between, and you can finish watching the video, right? So now we'll see. We have chapter 1 to chapter 18 chapters, out of which 17 and 18 is just for formality, we would say. Okay, because presenting information, this is nothing but showing how reports work, showing how email works, all these small cute information that we do not have to go ahead and study again, but we will still quickly skim through it. Right, now coming to spreadsheets, this is about answering these row, column, A1, B2, such questions. Okay, also we'll be looking at it in a very small way. Now coming to the section A questions, it can be tested from anywhere. But section B questions specifically will be focusing on 3 areas: budgeting, standard costing, and performance measurement. Now, budgeting is, it is said that budgeting is in chapter 13, but then a part of budgeting is also in chapter 12. And to test budgeting, we'll use a little bit of spreadsheets also. Okay, so all of these topics can be tested. Along with that, a little bit of investment appraisal also will be tested in budgeting. So in this one topic of budgeting, we have chapter number 12, 14 and 18. But standard costing and performance measurement, it is just like that. So if you can just remember these few chapters, if you can properly go through these few chapters, you will get minimum 35 marks. This is only the minimum. Okay, just with 3 topics: budgeting, standard costing and performance measurement. That's why, like I said, MA is an easy paper to pass, because only certain chapters, if you learn, you will pass. But if you want like really good marks, then you'll need to focus on each and everything. Okay, now let's start. We will, this is the important topic. Let me erase this now. Or no, let me keep it there so you can remember it. Now, let's start off with this chapter of management accounting. This is the first chapter. It just explains what management accounting is, what is the use of it, what is data, what is information, these small topics, right? Now, it is very rare that you get many questions from this chapter. Maximum 2 to 4 marks you will get from this, right? So, management accounting is a process of collecting, analyzing, definition. There's nothing to explain in definition. In management accounting, one thing you need to know is it is used not by external parties, but by internal parties. Okay. Now this includes everything: confidential secrets of the company, it's like a rough book. Okay. Now how in school, when you were in school, you had a rough book, right? Would you give it out for correction for your teachers? Would you write it in a specific format like your classworks? No, right? You had a specific format for classworks, not for your rough book. You will scribble whatever you want. If you want to draw something, you will draw something. If you want to do anything, you will do anything with that rough book, right? But the teachers will not ask, give me a rough book, let me correct it, right? So the teachers in this analogy is your government, is your stakeholders, is your shareholders, everyone, right? Because they need to test how your statements are. Okay, this comes under financial accounting. Okay, but we are looking at the inside part, which is a rough book for us. No one's going to check it, only the management is going to check it, right? And also along with that, we will know that no one needs to know about whatever we are writing. We will write what we want, no format required, no one to be responsible to. Okay, only the management, however they want, they will sit and scribble in the management accounting books. It is not something that is out for audit. Okay, right. So now what you need to know about management accounting, it is internal, it is forward looking. Now financial accounting, when we're looking at F3, we look at financial statements. Financial statements, we cannot predict in the future that it's going to happen, right? Whatever happened in the past, only that we will take, and we'll pick up certain information out of it and we'll put it on this thing. We will not put a lot of information in financial accounting, but in management accounting, you will need to keep it very detailed. Now, if you look at one classwork in your school, right? Let's say English classwork. Okay, you will have one book for the whole year, and that will still have some remaining pages in the end. You will not complete that book. But if you're looking at rough book in 1 year itself, how many rough books do we change? Okay, it is very, very detailed. Management accounting is very detailed as compared to financial accounting. It includes each and every information. Okay, and not only that, management accounting includes both historical and also forward-looking information. Okay. Right, not governed by any legal standards. Like we said, no need to audit the management accounting information. Okay, now coming to data and information, there is something called data and there is something called information. Now, data is something that doesn't have any meaning on its own. Now, without us going in, like, without processing it, we will not make any use of the data. Now, data doesn't mean like X, Y, B, G, random figures like that. It will just mean they will tell you 10 phone numbers. Now, what is the meaning of these 10 phone numbers? Whose phone numbers are these? What do we know? We know nothing about it if it's only data. But if we go ahead and process this information, these are 10 phone numbers of people who want to purchase the product. Good for us. We will call them and we'll be like, please purchase our product, right? So now that becomes information after it is processed. Understood? That's the only difference between data and information. This is how they can ask you. They'll give you like 4 MCQs, like 4 options, and then they'll be like, which one is data? Or they could be like, which one is information? Okay. Now, information needs to have meaning. That is one thing we know, right? Now, if any information has to be a good information, it should be accurate. Now, accurate is also an acronym, along with it being the first word of the acronym, accurate. Accurate, complete, cost-effective, understandable, authoritative, timely, and easy to use. Now, this particular thing comes in both management accounting and financial accounting. Data and information is a topic that repeats. Okay, so you need to know these things. They will not ask you for the meaning, most probably. They will ask you what could be a part of good information. Okay, and they'll give you 4 options. Could be accurate, complete, cost-effective, and enjoyable. Now, obviously, enjoyable is the answer which is not. Right, so this is the type of question they'll give you. Now, coming to planning, decision making, and control, these are the 3 main things that we'll be focusing on in this chapter. Planning is done by the top management. Decision making also top management. Control. Okay. Now, guys, there's something called Antony's hierarchy. We have strategic level, tactical level, and operational level. Strategic level is the top management, tactical level is the medium management, and operational level is the lower level of management. Okay. Now, top level of management is who makes all the decisions. Okay. So, top level of management are the people who will have these fancy meetings, wear good suits and all that, and come and take decision, but they will not go and do all the groundwork required. Okay, they will send their operational management, which is the last level, lower level of management, to do all the groundwork. So these are not the people who plan. Okay, these are the people who execute, and these are the people who plan. Understood? Now, we have strategic planning, tactical planning, and operational planning. 3 levels of planning, just like what we just spoke about: strategic, tactical, and operational. Now, strategic planning, they decide on a long term. Medium term is tactical, and operational is short term. Now, this is something like this. See, we decided we are going to become ACCA members, right? Now, that's a long term plan for us, strategic planning. Now, to get that plan running and into action, we will need to make short-term plans. Now, we cannot directly get up and be like, tomorrow we're going to be ACCA members. Not possible, right? We will have to go through a series of events before we become members. So before that, we'll have to write 13 papers. We'll have to get our work experience. We'll have to get our EPSM signed. Only then we can become ACCA members. Now, we will divide this into 3 different topics. Now, what is our short-term day-to-day goal? Every day study 2-3 chapters. Okay, so any plan that we make will have to subdivide it into tactical and operational planning so that we can achieve it. Anything will not go from step 0 to step 100 in just one step. Okay, that's why there is 0, 1, 2, 3 before 100. Now, we are talking about planning as of now, right? Any plan that we're making will have to be SMART. Now, what is the meaning of SMART? Again, an acronym, which is also important for you to remember. Now, if we plan something like I got up today and then I was very motivated. I wanted to be like entrepreneur. So I was like, okay, tomorrow I'm going to compete with Ambani. Is it possible? Tomorrow, if I like get up today, will be full motivated and then tomorrow I'm going to compete with Ambani? Obviously not possible, right? So what we're trying to figure out here is it is not possible. So we need to plan something. Although we planned it, it is not possible. It is not achievable, right? So before we make a plan, we need to make sure it is SMART. Now, what is SMART? Specific, measurable, achievable, relevant, and time bound. Okay. Specific is we know exactly what we need. Okay. We are not gonna, what is your goal? I want to be rich. How rich? That is gonna be your specific answer. Measurable. Again, here we will be like, see, improve profits, that is something we cannot measure, but improve profits by 50,000, yes, we can measure that. We cannot be like, I'm going to improve profits till I can shake the world. No. Okay. Next, achievable. Obviously, remember that Ambani example that I gave. This one, become India's top food in a week, no chance. But can you increase your shares by market share by 10%? Could be, right? Relevant. Now, if we are talking about let's say relevant, add 5 new coffee flavors. Now, our business is related to technology and we are talking about adding new flavors. Where are we adding flavors in technology? How is that possible? Understood? So now our relevant one will be develop a mobile app, improve customer satisfaction, like that. Time bound is, now for example, we're going to write the exam tomorrow. Okay. Important notes we're only getting day after tomorrow. Is it relevant for us again? Is it important for us? No. It is not at the right time, so it will not be necessary. Even though it is very important for us, we are not getting it on the right time. So then it becomes useless in the end for us, right? Okay, coming to the next one, which is decision making, which is just making decision, guys. So we'll have 2-3 options. Choose a proper one, which gives you the best profit, best growth in your business. Take a good decision, that one. Control is nothing but you will set a target. Actually, whatever happened, you will look at that. You will compare how much you decided. Now, we'll use an example. We set a target that we are going to get 80 marks. But actually, we got only 50 marks. Obviously, it is not the same as we had expected. We will compare it. Comparison shows that 30 marks, yeah, 30 marks difference is there. Now, our next task is not just sleep, understanding, oh shit, 30 marks, what is this, like that. We'll not think like that and sleep. We will analyze why did it go from like 80 to 30? We planned for 80. How is it 30 now? Okay, how is it reduced by 30 now? Okay, and then with this, you will take a corrective action, which means next exam that you're taking, if you're planning for 80, you will have to get 80 or 70 or anything better than 50. Okay, that is taking corrective action. Next is limitations of management information. Like I said, see, management information is internally generated, right? Since it is internally generated, it is very hard for us to, get all the information possible. And it is too much information. Too much information, if you look at, you will forget which is important, which is not important, right? So that's a problem. Now, all the information will not be relevant. Some information will be unnecessary. Now there are committed costs, sunk cost, all of this which are not relevant. Depreciation is not a cash flow. Now we cannot include all of this when we're taking management accounting decisions. Okay. These small things, you can easily get it once you have options. Now coming to cost classification shows there are 4 different cost classification. We'll look at that, but before that we will go through something called responsibility accounting. Okay, responsibility accounting is, let's say there is a robbery in your house. Who will you blame? Will you blame the security guard or will you blame your neighbor? Obviously the security guard, because his job was to protect the surrounding from robbery and this and that, right? So we know who is responsible for it when something goes wrong, and we know who is responsible for it when something goes right, so that we can reward the person. Okay, so if we know who is the person who should be rewarded or who should be punished, that is known as responsibility accounting. Okay, now under responsibility accounting, we have cost center, revenue center, profit center, and investment center. Now, most of the time they will give you options and they'll be like, which center's manager? Now, cost center will have a cost center manager, revenue center, revenue manager. Similarly for profit and investments. Okay, they'll give you questions like, who is responsible for this particular task? So you need to be ready. If they're dealing with something related to cost, we know cost center manager is responsible. If we are dealing with revenue, if you're dealing with sales, if you're dealing with anything, how many units we have sold, all that, revenue center. Profit center is something that deals with both cost and revenue, because how do you get profit? Revenue minus cost is profit, right? So that's why whenever we're looking at cost plus revenue, our answer will not be cost and revenue center, it will be profit center. Okay, now coming to investment center will include both the investment that we make, and after you invest, you will also get profit on that investment, right? Now that doesn't mean this profit will go under profit center manager's job. Okay, if investment and profit both are given, it goes to investment center. If only investment is given, it goes to investment center. If only profit is given, it goes to profit center. Got it? If cost and revenue both are given, it goes to profit center. If only cost is given, cost center, and if only revenue is given, revenue center. Understood? Now, this is the explanation. Again, you can quickly pause and read all of this if you want to. Okay, the notes for all this, I have taken the whole class for a month relating to with using the same material. Okay, so you can look at that also, guys. So one is cost object, cost unit, cost card. These are the 3 things we'll need to look at. Cost object is for anything which has a cost. Now, for example, if I'm looking at this pen, I know that if I want to buy this pen, how much I should spend. There's a cost for this particular pen. But if I look at one strand of my hair, can I buy it for 2 rupees? Can I buy it for 3 rupees? Is there some cost like that associated with it? No. Then that is not a cost object. But anything which can have a cost associated, like this pen, will have a cost, will be known as a cost object. Understood? Now, cost unit is like, if we are looking at things like a paint, a drop of paint, is there cost associated with the drop of paint? No. A liter of paint, yes, we can purchase a liter of paint, 2 liters of paint, like that. So a liter becomes a cost unit. If you're looking at, see, similar to that, a hotel room. Inside a hotel room, I just want one corner, I just want to sit like that, please give a discount. We cannot go tell. If you want a hotel room, you'll have to book the whole room. Right, you cannot be like, I am very thin, I will only take so much space in the corner next to the wardrobe, please give me that space, I'll give you 20 rupees for it. No. Okay, so if you're getting a hotel room, so that is cost unit. We cannot specifically include the small things, right? The whole measurable unit will be needed. Next, coming to cost card. Cost card is like a breakdown of the product. Now, for example, in this pen, we are looking at the plastic outside, the metal, all the I don't know, whatever this is. Anyway, guys, many things, right? So for each of this, we will have a cost associated, right? Now we'll use an easier example. I don't know about all these technicalities. So a burger, okay, which all of us know about. So this will have a bun, it'll have lettuce, it'll have tomato, it'll have onion, it'll have sausage or patty or whatever that we are ordering the burger for, right? So all of this will have a certain cost. Understood? So that is what we'll be including in the cost card. Now here we're just going into a little bit of professionalism and then dividing into direct material, direct labor, all of this, right? That is important. Now coming to the next one, this is a cost, this is the proper cost card. Okay, how are we getting this? Let me write it this side and show you. Okay, now for a cost card, we have something that we will look at known as direct cost. Okay, so direct cost involves three things. Understood? One is direct material, direct labor, and direct expenses. Okay, now all three of these have separate chapters. Chapter number 3, 4, 5 is related to direct labor, direct materials, labor, and expenses, right? Accounting for materials and all. Now, all the three direct costs together are known as prime cost. Understood? Another thing you need to know is, guys, indirect materials are also there, indirect labor and indirect expenses. All three of these are known as overheads. Okay, now after you get all these three, you will have to add in something called production overhead, which involves, now we are looking at production, we are producing it within the company, right? So within the factory, whatever the main expenses are incurred while producing the product, all of that comes under production overhead. Okay, now after this we will get something called total production cost. If you add non-production cost to total production cost, you will get something known as total cost. Now, what is non-production cost? It is something that is indirectly related to producing the product. Now, for example, we produce the product, we will not just keep it in the warehouse, right? We will have to sell it. But to sell it, we need a selling team, right? Sales team. That could come under non-production overhead. We need to market it, correct? Without marketing, people will not know that we are selling the product. Marketing team comes under non-production overhead. Admin, distribution, all these comes under non-production. Understood? And in total cost, you will add how much of a profit you need, and after that you will get selling price of the product. Now this is the whole cost card, which is very important as a whole format you need to know. Okay, now when we're looking at this things like direct material, direct labor, direct expenses, where do we know it from? Okay, so this is the format of cost classification. The whole chapter is based on this format. Okay, now this is the most important part also within the chapter. Now cost classification, we have it classified into 4 components. One is based on element, one is based on nature, one is based on function, and the last one is based on behavior. Okay, now when we are looking at element, it is divided into material, labor, and expenses, just like we look. Now we're not looking at the direct and indirect component of it because that component comes under nature. Okay, direct material, direct labor, direct expense, indirect material, all of this, right? Now function, when we look at, we will look at production, okay, and non-production. And finally behavior, which is the most important part for you, includes fixed, variable, semi-variable, and stepped fixed cost. Understood? This is the whole cost classification. Within this we can divide it direct, indirect, direct, indirect, and direct, indirect. Under this we can tell material, labor, expenses, material, labor, expenses, right? It just goes on. Okay, now this is where we'll be mainly focusing on. Okay, yeah, the same thing is shown here. Okay, now the main part of this is here. Under behavior, we have something called variable cost, fixed cost, step fixed cost, and semi-variable cost, right? Now variable cost, this is what we'll be looking at. You know what is variable cost, right? A cost that changes with the level of activity. Okay, now for example, if we are planning to, okay, let me give you a really good example which works for both variable and fixed cost. Now let's say you have this is you, your name is A, and you have 3 siblings, B, C, and D. Okay, now your parents need to pay for all of you going to school, right? So now school expenses. Understood? They will not be like 4. No, each person goes, you'll have to increase it. Now let's say the school fees is 1 lakh per person. Okay, now total, how much will your parents spend? If only A was going to school, you would spend 1 lakh. If B is also going, you'll spend 2 lakh. If C is also going, you'll spend 3 lakh. And if all the 4 are going, you'll be spending 4 lakh, right? So how many other people are going? That much it is increasing by. So total this thing will increase. Understood? Now, here total cost increases. So if 1 is going, that means if A is going, the cost will be 1 lakh. If B and A both are going, the cost will be 2 lakhs. If C is also going with them, the cost will be 3 lakhs. And if D is also going, the cost will be 4 lakhs, right? It will keep increasing. But when we are looking at cost per unit, now, will the college or school be like, no, A is coming, so that for him it is 1 lakh, for B it will be 20,000, for C it will be 30,000. No, it's not like that. For everyone, it's a fixed fee, assuming that they are not getting any scholarships. Okay, then you'll be like, no scholarships we're getting. No, just assume there are no scholarships or anything. Will the price go up and down? No, it's the same for everyone, right? So that's why even if 1 is going, 2 are going, 3 are going, or 4 are going, everyone per unit, only one we are looking at, the cost will be 1 lakh. Okay, it will be same if we are looking at cost per unit. Understood? Now, let's come to the same example. Okay, now all the 4, A, B, C, D went to the college. Okay, now college is really far from house for us, so they have booked like an apartment for them. Okay, now for this apartment, they'll have to pay rent. Correct? Now, it's a small apartment, let's say 1 studio room apartment, that's it. Now, within the studio room apartment, let's say the rent for this is 8,000. Okay. Now, guys, whether only A is staying in that apartment or whether A and B are staying or all the 4 are staying, the rent will stay 8,000. It will not go up and down. Okay. Even if all of them are not living for a month, they have gone back home for their vacation, they'll still have to pay this 8,000. This is known as fixed cost. Okay. Now, within fixed cost, this is what you need to know. If you're looking at the total cost, okay, total cost is 8,000, whether one person is staying, whether 2 people are staying, anything. Okay, so whether 1, whether 2, 3 or 4, 8,000 is going to be the total cost. Understood? But if you're looking at per person, if the total cost is 8,000, for each person, how much will it be? Whether A, B, C or D, everyone will have used as equal percentage of the room, right? So for each one of them, the cost is 2,000. Did you understand? Now guys, if all the 4 of them are staying, okay, then the cost will be 2,000 if all the 4 are staying. But if only A and B are staying, they still have to pay 8,000. But now each person, since only 2 people are there, each person is paying 4,000. Did you get it? Now, if only 2 people are staying, the cost is 4,000 per unit. We are talking about per person here. Okay. But slowly, if the percentage, that means if 4 people are staying there, the cost will become 2K. It is reducing slowly, right? If only, if not 4, if their friends are also staying with them, then it will reduce again. Okay, now each one, A's friend, B's friend, C's friend, D's friend, all 4 of their friends are staying. 8K and 8 people, 1K per person. That will decrease even more. Understood? Now, but this can never become 0. That's why it is staying here. Did you understand? Okay, this is the difference between fixed cost and variable cost using both total cost and cost per unit. Now, coming to the third one. Third one is a stepped fixed cost. Now we'll use the example of rent here. Okay, now same thing. Our 4 friends A, B, C and D are in college. They're staying in that apartment. Rent right now is 8,000. Okay, now they were staying there. Now the college is of like 4 years, let's say. First year they stayed there, 8,000. Next year the landlord will come. He's like, 1 year you already stayed. The property prices nearby are increasing. Please increase your rent to 10,000. Okay, although 8,000 was fixed for a very long time, after a while this landlord comes and increases it. Now it is going to be 10,000 for a long time, for the next few months or a year or 2 years. We don't know. It depends on landlord's mindset. Right now, let's say 2 years passed by. Now the last year of college, they are telling, come on, I let you stay 2 years without increasing anything. Please pay 15,000 now. Okay, now it's gonna be 15,000 for a really long time. Did you understand? This is stepped fixed cost. And finally, semi-variable cost. Now let's look at this, guys. Let's look at the diagram for total cost and cost per unit of both variable cost and fixed cost. Okay, now let's look at this. This is, let me write it here. Okay, variable cost variable, I've written variable cost. Okay, this is total cost. For variable cost, it is increasing, correct? Now same thing, cost per unit of variable cost is going to remain the same. Understood so much? Understood? Now let's look at fixed cost. Same thing, total and cost per unit. In fixed cost, cost per unit will remain the same. Total cost will remain the same. Cost per unit will slowly reduce. This is how the format is, right, for both of it. Now, a combination of these two will be semi-variable cost. Now, how is a semi-variable cost gonna be for total cost? Let's see. Let's compare total cost of variable and total cost of fixed. So fixed has this line here, right? And variable, it is starting from here. But fixed, we already drew that line. So from here we will start. Understood so much? We are just merging these two figures. Now, coming to, this is total, right? Total. And then we have cost per unit for semi-variable. Also merge the two diagrams. So here in variable and in fixed, both we are going to look at. Now, cost per unit for variable, they have that line, right? Cost per unit of fixed cost is going down slowly. So now this will only stop at this line. It will not go under this line. It's the same diagram that I just drew by comparing these two figures. Did you understand? So semi-variable cost is something that contains both components of fixed cost and variable cost in it. Did you understand the difference, guys? Now these diagrams are very important because sometimes they can give you the diagram and they can ask you which one is what. This is the example of the question that they could possibly ask you. Understood? Now, it's also important for you to know that whenever we are looking at these things, it is important for you to know which one is variable cost, which one is fixed cost. They can give you 4 definitions and they will be like, see, which one is fixed cost, which one is variable cost, and you should be smart enough to be able to figure out that. Okay, they'll give you an example. Like for example, I gave you the landlord's example, right? So similarly, they'll give you something with a little more complicated English, but you will need to break it down, make it easy for you to understand, use it in your scenario, and try to figure out which cost it could be. Understood? Right. Now, we just looked at semi-variable cost, right? Semi-variable cost, we know that it includes fixed cost also, it includes variable cost also. How much fixed cost does it include? How much variable cost does it include? That we don't know, right? But we should still know how much it is so we can assign it properly. That's why we use something called high-low method. High-low method is a way in which we can separate fixed and variable component of semi-variable cost. Understood? Now, to calculate high-low method using the cost. So what we are trying to figure out here is how much is the variable cost. Step 1 will be figuring out how much the variable cost is. After that only we'll be figuring out what is the fixed cost. Now, let's look at this example. Okay. First of all, you will find activity levels. Okay. Now we have 10, 20, 30, 40, 50, 60, things like this. Right? Now, out of that, which is the highest, which is the lowest, you'll have to figure out. Now, obviously, highest is 10, highest is 60 and lowest is 10, right? That we figured out very simple. This is step 1. Okay. Step 2 is finding the variable cost. Now, how do you find variable cost? But this one, guys, remember, variable cost, it is not total variable cost. We are finding variable cost per unit. It is important for you to differentiate. Like I said, there are different diagrams for it, no? So total cost and variable cost, you will think is the same. But then no, it is very important when it comes to the perspective of management accountants, right? So now this one is very, very simple. This one, you're just using the H minus L, what happened? Okay. Okay. H minus L strategy. This is the easy way to remember it, right? So H minus L, we are looking at the activity level. H minus L, we are looking at the units. How many units and how many activity level. Okay, don't worry, we'll do a sum. We'll just solve one quick sum for it. Okay. And then step 3, you'll be finding out what is the fixed cost. Understood? Now, fixed cost, we'll have to find the total cost, which will be given in the question most probably, minus whatever variable cost per unit we just calculated in step 2. Okay, in step 2, what we calculated into activity level, which will be given in the question. Okay, now using that, we can find out what is the fixed cost. Understood? This is the formula for finding fixed cost. Okay, guys, and after that, finally, once you have variable cost, once you have fixed cost, then you can make up something called the cost equation. Now, this cost equation is very important and will come in all the remaining chapters. Okay, it is something called y is equals to a plus bx. Okay, y is the total cost. Okay, a is the fixed cost. Okay, B is the variable cost per unit. Variable cost per unit into X is number of units. This is how the whole thing of high-low method is going to work. Understood? Okay, now let's go into detail with this high-low method. See, y is equals to a plus bx. This is the cost equation. Here y is total cost, a is fixed cost, b is variable cost, all that is given. Right? Now, you need to also know, also known as aka total cost, aka dependent variable, fixed cost, aka independent variable, x independent variable. Understood? All these also known as words like slope and gradient. All this you need to know. They will not sometimes give you B. They will ask you what is the slope, and then you will be confused. Slope, what is it? And then it will be very confusing. Okay, so remember this. These are easy marks. You don't want to lose all this. Right? Now, for example, this is the type of question they'll give. What is the gradient? What is the independent variable? What is dependent variable? They have given you the equation y is equals to a plus bx. Okay. Right. Next is cost codes. Now, cost codes is the like proper theory type of what is this theory type of theory. Okay, so this can be tested only as theory. Now, cost codes are something that I have rarely seen being tested, but we'll still go through it. Like I always say, if you're unlucky, guys, they will ask you something really new, and then you will not be ready with that option, because you will be like, in the past they did not ask this question, so probably they'll not ask, but they can. Okay. Now, cost code is whenever you are purchasing something, there'll be a bill. Okay, they'll write whatever you're purchasing, and next to that there'll be some set of figures like Y23 or ABC or something like that. That is like a small secret code for that particular product that you purchase. Now, for example, if I purchase this pen, this will have a cost code of, let's say, AXY. Okay, so in the store, if they tell AXY, everyone will know, oh, pen, okay, like that. But we will not know, right? It's a secret code for them. Okay, now that is cost code. Okay, now cost code includes the cost center code, generic code, and specific item code. Okay, now let's say this pen, I told you AXY. What is happening, guys? Again, I should write. Okay, fine. So we include cost code, generic code, and specific item code. Right? Now this pen, like I said, let's call it AXY. Okay. Now within AXY, let's say A is the cost code of it. Any pens could be ink pen, ball pen, gel pen, apple pen, any of it will start from A. Okay. Generic code is, now we will subdivide it. Is it apple pen, this pen, that pen? So for apple pen, it is called X, let's say. For normal ink pen, it would be A. Okay. Now specific item code is, how can we say this? Which Apple, now see, this has this flash type of charger, right? So now this will not work on the iPhone, which does not have it, or iPad, which does not have it. So using this, we'll also have to connect the other type of that pin or whatever and connect it. So now for that specific item, we will call it Y. So together it will be known as AXY. If we had to talk about ink pen, A would still be the cost code. Generic, we would call it A, because ink pen is A. Okay, and for specific item code, now let's say it could be blue ink pen, red ink pen, green ink pen, whatever. Now for blue, it will be B, let's say. So for this, the cost code will be AAB for blue ink pen. Understood? This is called cost codes. Now there are different types called sequential, block, hierarchical, significant digit code, faceted code, mnemonic code, etc. You can just go through this quickly once. Okay, like I said, never seen it very frequently being tested, but if you're unlucky, see, this is the type of question that will come. Okay. Okay, now coming to the third chapter. Okay, guys, focus. This is important even for financial accounting. So if you guys are planning to attempt it next or have already written it, go through this properly. Okay, now production department is the factory for us. Okay, so this is where items are being produced. Now let's say something happens and the product that we want is not present in the factory. Where are we going to take it from the stores department. Stores department is like the storage for them, like inventory, everything is kept in stores department, right? So they will go to stores department and they will ask for them. So they'll be like, please give us so and so product, we need the product. Okay, now let's come back to our favorite example of this pen. Okay, this pen they want to produce in the factory. For that they need plastic. They don't have plastic though, so they go to the stores department and be like, please give us 1 kg of plastic, we need to produce pens. Now stores department, if they have it, they'll directly give it off to production department. But what if there's like no stock in stores department also? Then they will go to the purchasing department. They will not directly, stores department never directly goes to the external supplier. They go to purchasing department. Now purchasing department will be like, okay fine, you want plastic, what kind of plastic do you want? PWC, PVC, yeah, PVC plastic, do you want this plastic, that plastic? They'll take all the specifications and they will get an idea of what type of plastic we need to order. Okay, now purchasing department will sit and search for different suppliers. Okay, supplier 1, supplier 2, supplier 3. Is supplier 1 giving good quality for good cost etc.? They'll figure out and then they'll choose a good supplier. Okay, after they choose a supplier, the supplier will be like, okay fine, we'll sell it to you after getting the purchase order. An external supplier will sell it to the stores department directly. Stores department, like I said, is a storage area, right? Now after stores department gets it, it will give it to the production department. Now this is the whole circle of what happens there. Got it? Now when we will look at this thing, we also need to look at some documents which are important, right? So now let's start with these important documents that are going to be tested. Okay, there are many questions that tests documents. For example, like this, they'll give you something like this and they'll be like, which document is it? Okay, it's very hard for you to figure it out if you don't know the whole scenario. So I'll take you through it very quickly like a story. Okay, let's start from quotation. Quotation is something that the external suppliers, now there is a list of external suppliers, supplier A, B, C, D. Okay, supplier A, B, C, D, all the 4 suppliers will tell. A will tell, I'll sell you 1 kg of plastic for 2 rupees. He will sell 30 rupees. 2 and 30 is too big. Okay, 20, 30, 15, 25. Now this is all the price that they are charging, right? All of this they will send it to the purchasing department. Purchasing department will decide, okay, which supplier is the best value for money, we will choose. Now in this scenario, obviously supplier C is the best for us because he's only charging 15 rupees, right? So that is quotation. Quotation is something that external suppliers send to the purchasing department in order for purchasing department to know how much they are charging for it. Okay, purchase requisition and purchase order. See, purchase requisition is something that stores department sends to the purchasing department. Purchase requisition. What is the meaning of this? They are just sending a letter telling purchase department, we need plastic. Okay, if they just tell it like, verbally, probably purchasing department could forget it or there could be no record of it, then that's problematic, right? So that's why we need to send a letter always. This letter is known as purchase requisition. Okay, now purchase department has looked at this one and then he has realized that supplier C is the best. But how will he communicate it to supplier C? He will send something to supplier C known as purchase order. Means, please supply us the product. He is giving an official letter for it. Okay, so this is like ordering. Okay, purchase order. So he will send it to supplier number C, supplier called C. Okay, now coming to GDN, supplier C is very, very happy that, oh, they have chosen me, what a lucky man I am and all that. And then they'll be like, okay, fine, we'll send the product. And now they'll dispatch the product to stores department. Stores department will get the product, But along with the product, the external supplier will also send something called GDN, goods dispatch note, meaning we have dispatched the goods. For example, this is when you order something on Amazon, Flipkart or whatever also, you get mails or you get WhatsApp messages telling your good has been dispatched from this area. It will soon reach your area and all that, right? So that is goods dispatch note, just to let us know that, okay, the goods have been delivered. I mean, not delivered, dispatched, okay, sent out from the warehouse. Okay, now the moment stores department get the product and GDN, they will also have to reply with something, right? So they send something called GRN, which is nothing but goods received notes. Yes, you have dispatched the goods. I have received the goods. Okay, we have settled it, like that. Okay, that is GRN, goods received note. Now, sales invoice is nothing but a bill, because we need to pay the money after we got the products, right? Supplier statement is the final statement that the supplier gives to us, telling how much is due, how much is to be refunded, all of that. Okay. Credit note and debit note is related to returns and refunds. Now, for example, if the customer did not like the product, okay, then he will send something called debit note to the supplier. So purchasing department will send debit note to supplier C, telling, I did not like your product, please take it back. Okay, and supplier C will respond using a credit note telling, okay, if you did not like my product, please give it back and we will refund the money. Okay. Next is something called remittance advice, which is not necessary for you, but this is just the payment details. If you've paid using a bank account, what is your bank account number? What is your pay name? What is your payer name? All this. Okay. Receipt is a confirmation given by the supplier telling, okay, fine, I have received the money that you sent. Okay. These are the documents which are very important for us to know about. Okay. Now, let's go to something known as computerized inventory system, extranet, TPS and MIS. Now, before starting all this, I think in chapter 1, we went through Antony's hierarchy, right? So here I told you senior management require very limited data. Okay, now let's say our store had a banana peel fallen down and a customer slipped on it and then he fell and it was funny for a moment, right? Now this particular thing the senior management doesn't have to know. He is already too busy to be knowing who slipped on it, who stole 1 rupees coin and all that, right? He will only get highly summarized information. Highly summarized information from whom? From the tactical managers. Tactical managers give them highly summarized information. Now, this is known as EIS, called Executive Information System. Okay. After this, tactical management also does not need to know too much in detail. Okay. A little bit summarized. Okay. Along with that, this particular department, they need highly detailed information. Okay, now they stole 1 rupees coin, then they'll have to think, oh, 1 rupee stolen, next 2 rupee can be stolen, next 3 rupees can be stolen, like that. Okay, so these people require something called TPS, transaction processing system, and tactical requires MIS, management information system. EIS is highly summarized. It includes both internal and external information, and yeah, so much is sufficient for you to know. And it is used by tactical strategic managers. MIS is used by tactical managers. It is summarized, not highly summarized. Okay, it includes internal information. Understood? Operational is highly detailed. Okay, they use something called TPS, transaction processing system, which includes only internal information. Routine information every day is same information. Okay, so if you know about EIS, MIS and TPS, it is sufficient for you guys here. Now, next we will go to something called inventory cost. Okay, components of inventory cost. Now guys, inventory cost includes 3 things: purchase cost, holding cost, and ordering cost. Okay, holding cost is the cost of storing the inventory after purchasing it. Ordering cost is like, you know, the delivery fee and this and that you pay while ordering the product that you're looking to order. Whenever you're ordering on Amazon also, same thing you'll have to go through. Okay, now for example, purchase cost, the formula is P into D. Now what is P? P is the purchase price for 1 unit, D is the demand. How many have you ordered, and for each unit how much is the price? Holding. Holding, the formula is cost of holding into Q by 2. Now what is CH, cost of holding? Q is quantity, Q by 2 is the average quantity. Understood? Finally, cost of ordering for ordering cost, and D by Q, cost of ordering, D is demand and Q is quantity. Okay, this is the total formula for calculating inventory cost. Okay, now this is known as the total annual cost of ordering inventory, right? Now along with this, what you need to know here is what comes under holding cost, very important. What comes under ordering cost? Okay, this is the type of question they can ask you in theory. So they'll be like, which one does holding cost include? Holding cost is nothing but storage cost, right? To store, you need a warehouse. For that, you need to pay warehouse rent, and you need a security guard. You'll need to pay him some wages. You'll need a supervisor to keep track of the security guard. You'll need to pay him some salary. You need to make sure that whatever you're holding is not obsolete. Otherwise, you'll have to trash it out and then purchase new inventory, right? So all of this you need to include. Storage cost, insurance, obsolescence, deterioration, administration, labor cost, risk of damage, all of this you need to include, and all of this comes under holding cost. This is also known as carrying cost. Okay, this is the formula that we looked at. Now coming to ordering cost includes, you know how delivery fee, right? And for companies specifically, we also have communication and delivery coordination efforts. Who is going to communicate? Within the purchase department, they'll have to communicate. Okay. Administrative cost, for what? For processing orders, for preparing the purchase order, for this and that. There are multiple costs for it, right? And obviously along with that, shipping and handling, what we also deal with for purchasing small things, right? This is the formula for it. Now other than that, we also have something called stock out cost and inventory recording and monitoring cost, which usually will not be tested for you guys. Okay, just to know, there are 5 costs, but 3 are the main ones, out of which 3 of it has calculation. Understood? Now this is what we just went through. Ordering cost, holding cost, and purchase cost will form the total annual cost of inventory, and each of what it means also is here. Okay, now along with that, we'll have to know about something called buffer inventory. What is buffer inventory? Now let's say you're holding 10 pens like this. Okay, but someday, now let's say someone very famous, who is very famous at this moment, I don't know. So someone very famous will go live, and on their live they will use this pen, and then everyone, all of their fans will be like, oh my god, my amazing star is using this particular pen, let's purchase it. And then that one day, although we only have 10 in stock, hundreds and thousands of people will come to purchase it. What are we going to do then? Okay, so that's why what we do is we hold a stock which we think of as safety stock. Okay, this stock, now we could have a stock of 100. We can never let the stock go below 100. The moment it goes below 100, we will reorder again. Understood? That is buffer inventory, nothing but safety stock. For some uncertainty of demand, supply, or whatever, you have something like this. Okay, now let's go to reorder level. Now reorder level is, remember I told you, the moment it goes down from the buffer inventory, you will order again. That is called reorder level. Which level is it? Now in our example, we assumed 100 is the level, right? Here we'll have to figure out which level that we need to, like let's say to calculate the 100, we are doing this formula basically. Okay, maximum usage into maximum lead time is the formula for it. Now this is very simple. Company uses so much per week. 5 weeks is the thing. Reorder is 12,000. What is the reorder level? Okay, we just need maximum usage and maximum lead time, that is 1,500 into 5. 7,500 is the reorder level. So the moment it goes down below 7,500 units, we will be ordering it. Okay, now sometimes what will happen is holding cost is too high. Sometimes ordering cost is too high. Okay, so most of the time, I don't know about you guys, but if let's say I'm ordering something, okay, I'm ordering a dress. Okay, now the cost of that dress is 490 rupees. Okay, but there's a thing that below 500 you'll have to pay delivery fee. So just to not pay that extra 10 rupees of delivery fee, I will purchase something else, right? That happens, right? So sometimes ordering fee is high. How can you reduce ordering fee? By purchasing more. Okay, so now I will purchase something for 300 more so that the delivery fee can become nil. Although I'm paying much more than I initially expected, but at least I'm not paying delivery fee. That's going to be my satisfaction, right? So this what we are doing is not holding, but we are just going to assume it is holding for the example. Ordering fee got reduced because holding fee increased. Holding fee will reduce if ordering fee gets increased, right? But there's a level in which both of them will be in the lowest, right? So sometimes holding will go up, ordering will go down. Ordering will go up, holding will go down, something like this. So this point where it is the lowest, that point is the EOQ. Okay, economic order quantity. Now, how do we calculate economic order quantity? This is the quantity that we exactly need to order to minimize our holding cost, ordering cost. Okay, now this is the formula. These formulas will be given for you in the exam. You can see EOQ is a formula that is given for you in the exam. Good for us. Do not need to remember it, but by the by the number of sums you solve it, you should be able to know what the answer is. Okay, now in this EOQ is the formula for it. Okay, and where each thing is known here, it is given. Now this assumption is again important. They can ask you in theory, what is the assumption for EOQ? They'll give you 4 options. Which one is the assumption? You will choose it. If they're asking you the question of which one is not the assumption, for that also you will choose an answer. Now the most important one here is there is no bulk discounts we are assuming in EOQ. Okay, along with that, we are just assuming that no buffer stock, no safety stock is maintained. Now these two are gonna be important assumptions for us. Assumptions have been tested, but these two in specific have been tested a lot. Okay, now let's go through something called, now this is the diagram that I was just showing you. If holding cost is increasing and ordering cost will decrease if you order many things, right? So then there's a point at which both of it is at its lowest, that is called EOQ. Purchase total cost will also reduce because of that. Okay, now next, EOQ and quantity discounts. Sometimes what happens is, let's say EOQ, which is the economic order quantity, is 500 units. Let me write it. 500 units. So if you order 500 units, you can buy it at the cheapest. That is the idea, right? But sometimes the supply will be like, if you order 600, I will give you 2% discount. If such a scenario happens, you should sit and compare which one is cheaper in both EOQ and the normal 600 after discount. Which one is cheaper? How will you do that? Just calculate EOQ, ignore this particular other thing. Okay, just calculate EOQ first. So you'll see how much is the EOQ. Here we have already calculated and we know that EOQ is 500 units. And now what you'll do is, EOQ is just the quantity. We don't know how much cost it is, right? So the cost for purchasing 500 units, you'll have to calculate. Remember that formula I told you, purchase cost, ordering cost, holding cost, all of that together you will add and you will get an amount. Okay. Next, you will use the same thing. You will try to find the cost for 600 units, but with a discount of 2% in purchase price. Okay, now this particular discount you will incorporate in the same formula and you'll get the answer. Now let's say cost for EOQ, cost for 500 units. I'm just assuming cost for 500 units is 1000 rupees. Okay, but cost for purchasing 600 units after taking the 2% discount is 900 units. Then in this scenario, EOQ is not the cheapest option anymore. Did you see it? So then you will need to go ahead with this particular thing, 600 units with 2% discount. Okay, this is how the whole step of EOQ with discounts is gonna go. EOQ is very easy to calculate. EOQ with discount is something that could be tested. Okay, now these are questions related to that. EOQ and EBQ. EBQ's formula will also be given to you in the exam. Do not need to worry. Now, EBQ is, EOQ is when we are ordering, economic order quantity, right? EBQ is economic batch quantity. This is when we are producing instead of ordering. Okay, when we are ordering, it is EOQ. When we are producing, it is EBQ. Understood? Now, in EBQ, this formula, this is what you need to remember because it will not be given in the exam hall. This will be given. Okay, so you just need to find out what is a batch that you need to produce. Every time you're producing, how much should you produce? Okay, how much should you produce every time you're producing? That is the question that is being answered by EBQ. Okay, next, maximum and minimum inventory levels. Now this is nothing, guys. How much are you maximum going to hold the inventory and how much is the minimum that you're going to hold? So there is maximum level, there is minimum level, okay, and after that there is also a level under minimum level called buffer stock. Okay, this is like the reserve for your vehicles. Now let's say you're driving a car or riding a bike. Okay, that time what happens is, you know, you'll fill petrol. Now let's say your petrol tank is empty, but still there's a small area called reserve area that keeps running, right? So using that small reserve area, you'll ride fast till the petrol one and then get the petrol, right? That is the buffer stock. Okay, now stock taking is like just counting how many stocks we have right now. Okay, that could be done using periodic or continuous stock taking. Periodic is once a while, so every once in a week, every once in a month, like that you will find out what is the periodic stock taking. Continuous stock taking is very regular, every day end or this or that, right? And there's also something that checks inventory in real time. Okay, real time means right as and when you're selling the inventory, it will automatically get updated in the system, computerized system, that inventory has gone down. Okay, so that system is also available. Now coming to the last part of the chapter, which is inventory valuation method. We have three methods. One is first in first out, known as FIFO. One is last in first out, LIFO. Okay, and the last one is EVCO, or weighted average cost. Okay, AVCO is nothing but average cost. Okay, now each of these have different calculation methods based within them. FIFO is you are selling whatever you're buying first. Okay, now let's say there's a milk packet. Okay, milk packet was purchased yesterday and today the customer comes. So first thing you'll try to do is sell the yesterday's milk packet because it could get spoiled, right? You are not stupid enough to give them, you're not that good hearted to give them the new pack today's, correct? So that is first, whatever you purchase, you're selling it first. LIFO honestly doesn't make sense. Okay, that's why they've taken it out of ACCA from many papers already. Management accounting will probably take out soon. But LIFO is what you're purchasing last, you're selling first. Now this is like you're purchasing yesterday's milk, today's milk, and when today a customer comes, you're selling him today's milk only. Then yesterday's milk, who will sell? It'll get spoiled, right? Then tomorrow's customer, you'll sell him tomorrow's milk. Today's milk, gone. Understood? So that is LIFO. Whatever comes last, you're selling first. And finally, average cost is you will take an average of yesterday's and today's and then divide the price of it and then give it. Now, if I have to give you an example of all the three, okay. FIFO is, let's say yesterday's milk price was 10 rupees yesterday because of some reason. Today's milk, the price is 12 rupees. Okay. In FIFO, today if a customer is coming, you will sell it for 10 rupees. Yesterday's price. LIFO, yesterday's milk again 10 rupees, today's milk is 12 rupees. Okay, if today a customer is coming, you will sell him today's milk for 12 rupees. Understood? Now AVCO is yesterday's milk again 10 rupees, today's milk 12 rupees. You will take the average of it, 10 plus 12 divided by 2, 22 by 2, 11 rupees you will sell it at. Okay, this is the difference between using FIFO, LIFO and AVCO. Now under FIFO, LIFO there are no subtypes, but under AVCO there is something called continuous and there is something called periodic. Okay, so both of it, there are different calculations. All of it is almost the same, right? And it is very rare that they ask you a full-fledged question related to all this, but this is how it's going to be, MCQ based, right? It's gonna be easy, don't worry about it. Okay, now finally we go to something called just in time. Just in time is just in the time of selling, you are purchasing it. Okay, a customer comes today, a customer comes today to purchase. Okay, you are not going to have the stock for it, but now only you'll call your supplier, a customer has come, please send it to send the product so that I can sell it to him. Now this one can work to like reduce your wastage, reduce extra stock, reduce holding cost will reduce, but ordering cost, how many times should you keep ordering? The number of times customer keep coming, you'll have to keep ordering the product. Now ordering cost is very high, whereas holding cost is equal to nil in this particular scenario. Okay, this is what you need to know. Now coming to this particular thing, all you need to know is, guys, if there is a reason where inventory is increasing, you will put it on the debit side. If there is a reason when inventory is decreasing, you'll put it on the credit side. Understood? That is all you need to know. You do not need to remember this table. Okay. In your mind, just know inventory is an asset. If asset is increasing, it goes to the debit side. If asset is decreasing, it goes to the credit side. Okay. With this, we are done with this chapter. Now, next is accounting for labor. Accounting for labor is a very tiny chapter, very easy also to go through. Okay, accounting for labor is like this. See, for the laborers, okay, how are you paying them? Are you paying them wages? Are you paying them salaries? Is it direct, indirect, that? So direct labor is when it is directly related to the product being produced. Now, for example, the product is this pen, like always, right? And then what happens is, there are people like marketing, selling, distribution, that department, right? That is also useful in selling the pen only, but it is not directly involved in making the pen, right? So who are the people involved in making the pen? Laborers, factory workers, all these people, right? They come under direct labor. Okay, indirect labor is the marketing department, administration department, HR department, all the other department employees that indirectly contribute in helping the production department. Understood? Now, if you're looking at another example, for example, ArivuPro, right? It is an educational firm. What is the direct labor? What is the main, work for them? Teaching. Correct. And who are the people who teach? They become the direct labor. Now, for example, I will be the direct labor in the company. Okay, because I'm teaching. Now, before I start teaching, there are many teams that help me in organizing this setup. There's operations team. There is admin. What is this? Administration team. There is academics team. All of these different teams that help me in all this, but they are not directly teaching. Right, but they're helping me in teaching, so that becomes indirect labor. Did you understand? It depends on industry to industry, and according to that, direct and indirect labor is determined. Okay, now for example, payroll department function, this is important. There are two things. One is time related systems, okay, and one is output related systems. Now, time related systems means according to the number of hours that you've worked. That will give you time related system type of pay. Okay. And output related system is the number of tasks that you've completed according to that. Now, for example, let's say within ArivuPro itself, we have two types of faculties. Let's talk about direct labor. Okay. One is full-time faculties and one is freelancers. Freelancers work on hourly basis. Full-time workers do not work on that, right? Now, what is the meaning of this, guys? I am coming to the office. Let's say I'm the full-time faculty. Okay, let's say that. And then I'm coming to the office. I'm coming to sit. I will sit here. I will not do anything. I will just sleep the whole day. I will still get money. Did you understand? That is time related system. The number of hours you're sitting in your workplace, you will get money for it. Okay. So this is the usual 9 to 5 jobs that we are working for. Understood? But output related system is like this. Let's say now the freelancers, the hourly based teachers that I told you, they will get, let's say they're getting paid on topic. If you complete 2 topics, you get 2000 rupees, like that. If you're not completing any topic, and if they're not even, taking one topic, then they will not get anything. Okay. But if it's full-time faculties, even if they're sleeping, they will still get money. Okay. But at the same time, here, if they're working too much, taking multiple topics, they'll have to get paid a lot. But these people, even if they're taking hundreds and hundreds of topics, they will still get paid the same. Okay. That is time related and output related system. Did you understand? Now, for total wages, this is the formula: total hours worked, basic pay; overtime worked, overtime pay. Now, let's say my job timing is 9 to 5. Okay. Now, any day if I have to work over 5, I will be working overtime. Correct. Now, let's say my general fee. Now, here total hours worked. How many hours is it? 8 hours. Okay. And overtime, I have worked for, let's say, 2 hours. Okay. And my normal basis of fees, normal labor wages are 200 rupees. And if I'm working overtime, I get double. So that is 400 rupees. Okay. So much is it clear? Now, this is a formula. Total hours worked is I worked for 8 hours. Basic pay is 200 plus overtime hours worked. I worked for 2 hours, and that is 400. So this is how we calculate the total wages. Understood? Next, coming to output related system. Now let's use another example of, let's say we are in a factory. Okay. There is a group of people whose work is to sew buttons in a shirt. Okay. So the number of shirts they sew the buttons for, they get paid on the basis of that. One shirt, you will get 20 rupees. 2 shirts, obviously 40 rupees, right? But then they'll give you a target so that they encourage you to work more. So they'll be like, if anyone crosses 20 shirts, here the pay per shirt is 20. But if anyone crosses 20 shirts, your pay will automatically increase to 30 per shirt. So till 20 shirts, you will still get 20 rupees. But the moment you do the 21st shirt, your pay per shirt will become 30 rupees. But till 20 shirts, it is still 20 rupees. Understood? Now, that is called differential piecework system. Looking at how many units are producing, just to motivate you, they'll increase. For example, 0 to 5 units, 4 rupees. 51 to 100 units, 5 rupees. Like that. Okay. Next is all these examples, right? Now, activity time recording, right? This is important here. Basic pay, overtime pay, and overtime pay premium. Now, basic pay is direct. Okay. Any day that you're working overtime, you will be included under indirect labor. But there is one but here. Okay. If the overtime work is because a customer wants you to work overtime. Okay. Because of a customer specific requirement, if you're working overtime, that overtime will become direct. Any other type of overtime will become indirect. Okay. This is a very important formula. Overtime pay is basic pay plus premium component. Understood? Now again, here we have this particular thing. Labor cost is always a cost for us. It's an expense. Okay. Now that's why bank, that means expense is being deducted, and all this we are spending on labor. Understood? These are the ratios that could be tested, guys. Now, you do not have to know what each ratio means. They will not ask you, but they will ask you to calculate and tell you what is the percentage, what is the figure for each ratio. So that part you need to be sure about. Understood? So you can go through this. You can take a picture of this really quickly and remember the sheet. Under labor, they can ask you no more ratios than these. Okay. And this will not be given in your exam. So you need to be thorough with this. Right. So now let's go to the next chapter, which is accounting for overheads. Overheads are the indirect expenses, indirect materials and indirect labor, if you remember when we went through it in the first chapter. Okay. Now, if we're looking at accounting for overheads, what happens here is, guys, we will need to first figure out how many types of overheads are there. So remember I told you there is something called production overhead and non-production overhead. Yeah. So production overhead is a separate topic. Under non-production overhead, they generally divide it into administrative overheads and selling and distribution. You can add in more. You can add marketing overheads, but that will anyway come under selling and distribution, like that. So general classification is already given here. Understood? Now, absorption costing is something that includes all production costs. Now, there's a thing called absorption, and there is a thing absorption, and there's a thing called marginal costing. Okay, absorption costing is something that includes the total cost, which includes fixed and variable. Marginal only includes variable cost. Fixed cost, they treat it separately like a different cost. It is known as period cost. Okay, now absorption costing also takes the fixed cost. Fixed cost is like fixed cost, right? Rent, this and that. Okay, now we're just gonna assume, to take an example of fixed cost, I will take rent mostly. Okay, because rent is an easy example for you to understand. Now, guys, whenever we are looking at absorption costing includes all the production cost, which includes production cost and non-production cost both. Okay, now that is fixed and variable. Okay, now this is nothing but it is being absorbed into the unit. The steps for this are very easy. First, you will allocate it, you will apportion it, you will reapportion it, and then you will absorb the cost. Okay, these are the steps involved in absorption costing. Okay, now using this we will have to solve sums. Like I said, sums we will not be doing in this marathon, but if you want to get an idea of it, you can still, we can see what to do. By the end of the video, you can just comment about whatever you want, and we will see if we can provide that. Okay, now this is a very, very important topic, impact on profit. Using when inventory increases, when inventory decreases, is absorption costing higher or lower the profit? This is very important, guys. Each and every attempt, almost every alternate attempt, this is tested. Okay, so if inventory increases, you should automatically know that absorption costing shows higher profit. Okay, and if inventory decreases, absorption shows low and marginal shows high. This is very important for you to know, because absorption deals with both fixed and variable cost. Okay, so if inventory is increasing, the total inventory will increase, which leads to cost of sales decreasing, and which leads to, if cost is reducing, obviously profit will increase. Okay, so that's why if inventory increases, cost of sales decreases, and as a result of that, profit increases. Okay, all right. So now these are the steps that we looked at: allocation, apportionment. Okay, now under apportionment, you need to understand. Now, guys, this is something, let's see. We have a production department 1, production department 2, service department 1, service department 2. Now, let's say under production department, we have sales. This is manufacturing. Service department 1, canteen is an example that always runs. And service department 2, HR, because HR works for all the departments. To purchase, to get employees, HR is the one that goes into all the departments. Each department don't go and recruit for themselves, right? So now, guys, these are the departments, right? So first of all, let's say the rent of this whole room is 10,000, or 10,000. Okay, 10,000. Now, sales department should pay 2,500. Canteen should pay 2,500. Manufacturing should pay 2,500, and HR should pay 2,500. This is how generally it should work, right? But guys, you know how canteen and HR within itself do not produce any revenue, but they help the others in producing revenue, right? HR and canteen services are taken by all the other departments, but they are not producing anything directly. Correct? That's why they come under service departments and they come under production departments. I hope that part is clear. Okay. Now, guys, what happens here is this 2,500 and 2,500, where will they get from? Because they are not producing anything, right? They are not able to use this. So what happens is we will have to use something called apportionment and reapportionment for that. Okay. This you will only realize once you're doing sums. Understood? Now guys, there are three different types under reapportionment. We'll look at that first: direct method, step down method, and reciprocal method. Now in one word I'll explain these three. It's sufficient, okay, because other than that you'll only need to do the sums and there you can figure out. So we have direct method, step down method, and reciprocal method. Now understand, under direct method, S2P, S1, S2 and P, S1 back and forth, S2 and P. Okay, I'll tell you. So here we are looking at S as service department and P as production department. So when service department is providing service to every department, right? No, service department is only providing service to production department. Okay, in direct method. Now guys, this is not logical because canteen services, obviously HR is not like a, you know, low caste person who has to go sit in the corner and will not get canteen services. Obviously not, right? HR, even though they are service department, they are still using canteen services, and canteen is itself using canteen services. They are eating, the people who are cooking and serving are eating there, right? So this is a little bit, you know, it doesn't make sense, but still under direct method, they are telling service department can only provide services to production department. Okay, same thing. If you're looking at this service department, they are providing service to production department. This is direct method. Okay, now coming to step down method, here service department one, only one service department can, first of all, they can provide it to both the production departments, that is there, but along with that they can also provide it to one service department. But this service department cannot reciprocate back the feelings that service department one is given. Okay, so only one service department can give it to another service department cannot give it back, but it can give it to production departments. Okay, coming to the last one, reciprocal method is service can give it to production and the other service department. It cannot give it to itself. Understand that. And service 2 can give it to production 1, production 2 and service 1. So they can give it to everyone. This is what the three methods are. Okay, direct method, step down method and reciprocal method. Now these are the sums that I would suggest you guys can try doing. Take a picture of it and try solving it and see if you're getting it. Okay, this is the continuation of it. You can take a picture and you can try solving it. Okay, next is absorption for overheads. Now whenever we are using absorption costing, sometimes we don't absorb exactly as much as it is shown. So we use, sometimes there is under absorption when we absorb less, sometimes there is over absorption when we absorb more than the actual. Okay, so I'll give you an example of how to solve this particular thing. Okay, now guys, in this scenario, what happens is, let's just assume that in this scenario, we have a budgeted cost. Okay, our budgeted cost is $10,000. At the start of the year, we budgeted that our cost is going to be 10,000. Okay, our units also, budgeted units, we thought we will be, producing 1,000 units. Understood? So if you're looking at per unit, okay, per unit, how much was it that the cost we thought it will be? 10,000 divided by 1,000, right? So that is 10 per unit is what we assumed, correct? All this comes under budgeted, right? But now when we look at the year end, what exactly happens? We produced the actual, let me write actual so you don't get confused. Actually, we produced not 10,000, but we spent 11,000. We spent 11,000. And how many units did we produce at the end of the year? Let's say 900 units. Okay, we spent more, but we produced less. Did you understand? This is the scenario. Now, guys, we were essentially supposed to spend 10 per unit, correct? But we spent total 11,000. You can see this, right? If we would have gone by this particular thing, right? For 900 units, we should have essentially spent 9,000, correct? 9,000 is what we should have spent, but instead of that, we spent 11,000. Now, is it good for us or bad for us that we spent more than we thought we would be spending? Obviously bad for us, correct? And we thought it is only going to be 9,000, but we actually spent 11,000. In such a scenario, this is known as under absorption. Did you understand? Now, let's change the scenario a little bit, and let's say our actual amount was the same, 11,000, okay, but our number of units are not 9,000. It was, let me change it. It was not 900, but it was 1,200 units. Okay. Now, for 1,200 units, how much were we supposed to spend essentially? 1,200 into 10, 12,000. We were supposed to spend 12,000, but we only spent 11,000. Amazing job. We spent less, right? But we thought how much we will spend? 12,000, correct? So then this becomes over absorption. Did you see? I've solved it using the exact steps. Okay. So first you will have to calculate per unit. Now this is known as OAR, overhead absorption rate. Per unit, how much money are you spending? How much money are you allocating? Okay. Second step, what we will do is you will have to find out what is the actual absorbed units. So let me write it here. Step 1, OAR. Step 2, actual absorbed units. Here the actual absorbed unit was 7,000. Step 3, compare the actual and absorbed and find out if it is under or over absorption. Okay, this is how it goes. So first calculate what is the OAR. Find out what is the overhead absorbed. This is OAR into actual activity level. Okay. If this is more, over absorption. If absorbed are less, under absorption. Right. So there's this one example that I've done. You can look at it and try solving it. And this is another question. You can try solving all of this. You can pause wherever necessary. I'll go slow. Okay. So with this, we are done with chapter number 5. Now, chapter number 6. Now, we're going slow for the first few chapters because all these are theory chapters. The next few, there's just 1 or 2 formulas. You need to take the formula and just solve it. Okay. So that's why I'm going a little slow in the first few chapters. Absorption costing and marginal costing, guys. There's one main thing that I would like to tell you here, which is what is absorption costing, what is marginal costing. We've already gone through it, but still. And other than that, there's nothing much if I'm being honest. So marginal costing is something that only includes variable cost and it treats fixed cost as period cost, which is like a separate cost. It is not coming under the cost of the product. Okay. But coming to where is absorption? Okay, fine. We'll finish marginal costing first. This is particularly useful for short-term decision making. So much information, sufficient. Okay. Now, we'll come back to contribution, but before that, let's go to absorption costing. Absorption costing is full costing. It includes everything. It includes variable cost and fixed cost both. Okay. Here we will sometimes what happens is over and under absorption could be there. Marginal costing will not have over and under absorption. We just finished how to calculate over and under absorption, right? Now, here you can see, guys, that in absorption costing, we are also including fixed overhead. And we are letting it be under cost of sales. Did you see that under cost of sales, fixed overhead cost is there. But in marginal costing, under cost of sales, there is no fixed cost. But fixed cost is here in the end. They are treating it as a separate cost. Okay. Along with that, one more thing that they ask you to know is about contribution. Contribution is nothing but selling price minus variable cost. That will give you the amount that is necessary to be paying the fixed cost. Okay. So contribution also you will need to know per unit and total contribution. First of all, find out what is per unit. Sales per unit minus variable cost per unit, and then the same contribution per unit you can multiply by units sold to get total contribution. Now this is how it works, guys. So first we have selling price. We reduce the variable cost. We get contribution. Now from contribution we can reduce the fixed cost to get the remaining profit. Understood? This is all you need to know for this particular chapter. Okay, that's it. Also, this one formula you can remember, this is the relationship between absorption and marginal costing. Sometimes they'll give you the OAR, they'll give you the change in inventory, they'll give you absorption costing or marginal costing, and they'll tell you to calculate the other one. Okay, next. With this, we are done with the chapter. Okay, now after this, the chapters will become shorter, easier, and faster we can complete. Okay, so far it was basics. Now, since you didn't know anything about management accounting, they gave it in a little more detail. Okay, now coming to the next chapter, job, batch, and process costing. These are three different types of costing methods that we'll be going through. And along with this, the next chapter will be related to alternative costing, which is a few more types of costing methods that we'll be going through, right? Okay, now guys, job costing, we'll start from there. Okay, costing systems, first of all, there is something called specific costing and continuous costing. Okay, under specific costing, now specific costing is for one specific customer. You are creating a product, and for that you need to cost it specifically. Continuous costing is not specific for each customer. Whichever customer want to come, they can come, purchase the product and go. Now, for example, when we are building a building, right? Each customer will not require the same thing. Everyone will have a separate understanding about the building. They will need stairs. Some will need lift inside the building. Some will need a fountain within the building. Many different specifications are there, right? For such specific type of products that we're selling, we will have to go ahead with specific order costing. But if we are selling things like this pen, it cannot be customized. Even if, you know, different, like really famous people come, or if I go, they will sell the same pen only, right? So continuous costing is the same for each and everyone. Understood? Now, under specific costing, we have job costing, batch costing, and contract costing. We do not have contract costing in our syllabus, so we can forget about it. Okay, but job costing and batch costing, both of these topics are in this chapter only. Now, coming to continuous operation costing, process costing, also in this chapter, service costing, also in this chapter. Okay, now job costing is for one specific person, one specific job you're doing. You're treating it as like a separate task altogether, and you're selling it. You're customizing it properly for the customer. Okay, now if the customer will not purchase it, it will go to a waste because no one else will buy it. Okay, until you are able to find. Now, for example, let's say a tailor. Okay, he will take measurements for a person and make a kurta or blouse or something like this for a lady. Okay, now let's say this lady, she doesn't come after that. She'll give the measurement and all that. She doesn't pay or anything. She goes away and they don't pay, right? So then this product is gone to a waste, because now if the tailor has to sell it, he has to find someone with the exact measurements of that lady, and then so that he can sell it. Otherwise, who will buy the same customized product, right? And the design also many people will not like. Understood? So this, whenever you're customizing it, that is job costing. This is not necessary. Okay. Job costing card is same as the normal cost card. Direct material, direct labor, direct expenses will give prime cost. Then you'll get total production cost, then total job cost. Okay. Now, you need to know the difference between markup and margin. Markup is a percentage of cost. Margin is a percentage of selling price. Okay. Now, coming to batch costing, this is a very tiny topic. Only so much you need to know in batch costing. Batch costing is like when you're producing in batches. Now, this one we learned in EBQ, economic batch quantity. That is when you're producing everything in a batch. Now, for example, guys, when I was teaching also, I was giving this example of cookies. Cookies, you will not put one cookie into the oven and produce, right? You'll produce it in a whole batch, in that plate that you produce, right? I am not sure. I'm watching all these Instagram reels and I'm getting the information from there. Could be wrong. I am not sure. But then again, cookies, according to my knowledge, they produce it in batch, right? That is batch costing. That is something when you're using identical items. Okay. 1 cookie, 2 cookie, 3 cookies you can make like that, right? So you will not sit and create it like individual jobs. You will apply it in a batch. Okay, so cost per unit for each batch is batch cost by number of units. Okay. Now, finally, we go to process costing. Process costing, one second. Okay, process costing is when we are looking at homogeneous products, same type of product, and when they are mass produced. Many things are produced in one go, that is process costing. Okay. Now, it is very hard to differentiate process costing like one process from the other here in this scenario. Okay. So now, how does process costing work? Here we will be looking at something called unit cost. First, we'll calculate the unit cost of a product. Per unit, how much are we charging? And that same price we'll charge for everyone else. Okay, that's it. Now, within this, you will need to know about some terms called normal loss, abnormal gain, and scrap value. Now, guys, most of the time, okay, when I was learning how to make dosa and all that, I realized how the first dosa never comes out tasty. Correct. So I will give it to someone else and the nice one but never mind. That's not the point here. So whenever we are cooking the first dosa, first chapati or whatever, the vessel, the tawa is still getting, they're using some time. It's taking some time to get heated, right? So the first one will always most probably not be the best one, right? So that first one is usually, it's going to go for a waste. So that will be normal loss. Okay, but sometimes, let's say while carrying the batter out of the fridge and then bringing it till the kitchen, till the stove, what happens is I trip and I fall down and the whole batter, goes into a waste. Now, that is not something I expected. First, those are going into a waste, totally acceptable. I expected it. Okay, but tossing it down on the floor is not something called abnormal loss. But sometimes what happens, let's say there could be abnormal gain also. Now, for example, I already have like a box of batter in my house, but my neighbor is like, tomorrow I'm going out, this batter will go for a waste, please, you can use it. And then I have too much batter now, right? So that is gain for me, abnormal gain. Okay. And finally, there is scrap value. Scrap value is when if the product is lost in such a level that you cannot even sell it. Okay, then you will have to just sell it to scrap. Like this happens when after every class we sell our books to this what is this person called, a person who weighs in kgs, and then he's like, okay, so much plastic will be 12 rupees and paper will be 10 rupees and all that, some sort of person like that, right? So we'll sell it off to him because no one else wants to buy the remaining books now. Used notebooks, who will buy? No one. So we'll sell it for scrap. Similar is scrap value. Okay, so these words you need to know. Now, this is a very important box. Okay, sometimes they will give you input and normal loss and they'll ask you to calculate expected output, or sometimes they'll give you this and ask you to calculate this. So any of this within the table, up and down, they can do and they can ask you, right? So you should remember this table. Now, finally, going to multiple products. Multiple products is when from one product you're getting multiple other products. Now, for example, let's say the joint product. We are talking about, let's say, coconut here. Okay. Now, coconut is what you're preparing. Now, because of a split process, let's say we are taking the coconut and we are cutting it. Okay. Now, from coconut, what can come? Coconut water. Coconut, that flesh, which is very tasty, and the last one is coconut husk, right? Husk is that outside thing that you can use to put inside the fire and all, bonfire, right? So now all of these are there, but some product, for example, coconut water and coconut flesh could be more expensive than coconut husk, right? Coconut husk will be what, for 1 rupee or something, for so much, right? So some products will be expensive, whereas some products will be cheaper in the same process. Okay, so now what you need to find out is which one is expensive, which one is cheap. Whatever is cheap will become the byproduct. Okay, now let me give another example. Okay, fine, we'll use the coconut example only. No, we can use bread. Okay, after the split off point, what will happen is it will be divided into the main product, which is cake, and another product is breadcrumbs, which you can feed the duck or put it outside the hot dog and all that, right? Sausage out of that, right? So that will become a byproduct because it is cheaper. Okay, and then you can use it to feed ducks or whatever it is, right? Cake, what you can do, you can either just sell it as plain cake or you can process it a little more. How are we processing it? Adding some cheese into it to make it cheesecake. Now, selling the cake at 100 rupees is beneficial, or buying cheese for 50 rupees and selling cheesecake for 300 rupees is beneficial. Obviously, selling cheesecake is beneficial, right? You're spending only 50 rupees extra and you're getting 150 rupees profit, right? So you should be able to understand when we need to process further, when we should not process further. Similarly, you just compare what is the final product and cost minus the first product. Okay, this is joint product. Now, there are different measures. One is physical measure, market value, and NRV, net realizable value. Physical measure is looking at what is the weight of it, how many kgs is it, the price will be determined. Market value is how are the people valuing that product, and according to that we will sell it. And finally, NRV is how much cost did you spend, okay, and after that how much should you sell it for to make a profit, that is net realizable value. Understood? These are cost apportionment methods. Again, there are different examples for it. You can go through it. For example, if I look at this one, you can either sell this product for 20,000. I'm not looking at this question, okay? I'm just giving an example. You can either sell product at 20,000 or you can process it a little more and then sell it for 18,000 per kg, and there are 60 kgs. So 18,000 into 60 kgs, I don't know guys, whatever X amount will be there, okay, minus the process cost of 80,000, and then you will have to compare it with 20,000 kgs, that is 200,000, 500,000, 700,000 you spent for this. Either this is beneficial or this is beneficial, you will have to figure it out, okay. Fine. Now next chapter is chapter number 8, which is service and operational costing. Okay, now in service and operational costing, what is important here is just a small area. We'll go through it. Service costing, remember I told you in the previous chapter itself what it is, right? Now under service costing, guys, we'll have to know what exactly a service is. Okay, what is a service? It is not a good, it is something that you pay for but you don't end up with any. For example, if I'm getting a haircut, okay, I'll get a haircut and I'll come back home. Do I have some product in my hand that I spend the money on? No, it's already done. It's in my hair now. Okay, if I'm going to a spa, also same thing. I will not come back home with anything, but I would have spent for the service that I received. Same thing. If we are using Uber or Ola or something like that, we will pay for the travel. After they drop us, what are we having in the end? Nothing. We just spent for the service that was incurred, right? So now in this, what you need to know is services are intangible. You cannot touch it. In the end, you are not holding anything, right? Heterogeneity means every service provider is different. Now see, I'm giving the marathon for management accounting. There could be someone else giving marathon for management accounting. They could be solving only sums and leaving theory. I'm doing the opposite. Someone could be doing both of it, right? So everyone has a different way of doing it. So heterogeneous. Simultaneity is nothing but whenever you're providing the service, you will have to consume it right then and there. Now, for example, I will go to a salon and I'll be like, please cut my hair. Okay, you can cut it today. I will collect the service tomorrow. Is it possible? They'll cut my hair today and I will receive the haircut tomorrow? Obviously not. When they're cutting it, I should sit there and receive it, right? So simultaneous. But this one is a little bit arguable in this scenario, because nowadays I am providing the class right now. See, I'm going live right now and I'm teaching it. But some of you might, not be interested right now, but then next month you'll be writing the exam. So before the exam, you'll want to watch the marathon. But this YouTube link will be right here, no? So you can go ahead and wait for the next month and take the service then. Although I'm providing the service now, you will be receiving the service at the month end. Correct? So this is not simultaneous. So because of technology, this particular point nullifies now, but still it is there as a part of management accounting, could change in the future. Okay. Then we have perishability, means services cannot be stored. Now this is like, let's say you booked a hotel room. Okay, and you did not buy the hotel room, you only booked the hotel room. So today you booked it for tomorrow. You cannot go there and be like, see, I booked it yesterday but I want to use it today. That is not possible. Okay, it perishes. Right, those two are not necessary. These 4 points are very important. Now, coming to cost units, we have something called a simple cost unit and composite cost unit. Simple cost unit, you remember cost unit we learned in the second chapter only. So cost unit is for each thing you're having a cost. Now, for example, per haircut, per GB, per car wash, etc. Right. Composite cost unit is when you don't have just one cost unit. Now, for example, let's say I am traveling. Okay, I'm in Bangalore and I'm traveling to Chennai for some reason. Okay, and my friend, this is my friend, wants to go till in between Bangalore and Chennai. I'm just gonna assume there is going to be a place called ABC. Okay, now guys, from Bangalore to Chennai, I have to pay 1,000, let's say. Will my friend also pay 1,000 if he just wants to go to ABC? No. So it is not per person, right? But let's say it is per distance. Okay. Now let's say, where is this? Yeah, per distance. Okay. So me and my friend together sit in one seat and then we'll be like, let's go. Then we'll only look at per distance. Is it possible? Only distance, only person, we are not looking at it like that. Okay. If one person is going, we will measure the distance he is going and also how many people are going. In one seat, we are assuming only one person. So one person and distance. So two things we are looking at every time we are traveling. In this, it is kilometer per head. So now we have two cost units here. Did you understand? Here like this, there could be multiple cost units. If we are looking at a hotel room, okay, per night, we cannot tell because how many people are going also matters, right? So per bed, per night. Per bed is nothing but per person here. Okay, they are assuming in one bed, two people cannot sleep. Okay, small bed we are considering. So per bed, per night. Okay, and next is for the haulage, for example, for goods being carried. Okay, so there they'll see how much is the weight of the goods that you're carrying and how much is the distance. Like how in this example we saw kilometer per head. In this it is kg per distance, kg per kilometer, like that. Okay, that is composite units. Now they'll ask you questions related to composite cost units. They can ask you which one is based on what example. Okay, you need to be aware about this particular concept. Understood? Now next is all this is fine. Yeah, this is important. The formula for cost per service unit, total cost and number of service units delivered in that period. Now this is important because this is how they will ask you questions. Okay, with this we are done with that chapter. Now we are going to something called alternative costing. Now you can see first, before that we had job costing, batch costing and process costing, and then we had service costing, and we had now we are going to alternative costing. Okay, so there are multiple costing techniques itself here that you need to be aware of. Okay, so now there is something called modern and traditional. Okay, costing, modern and traditional. Traditional is something that we've already gone through, which is absorption and marginal. Right now, under modern, right now we'll be learning about three. One is ABC, called activity based costing. One is target costing, and one is life cycle costing. Okay, so these things we'll be looking at. This we've already looked at, right? So now life cycle costing and target costing, I'll explain it right here. For ABC, we'll go to the theory and we'll look at. Okay, so now life cycle costing is just looking at the product from birth to death, you can say. Okay, ever since you started researching on that product, not even produced the product, but just started researching on the product, the research expenses, the production expenses, till the end decline expenses, everything, all the cost will be included in life cycle costing. So it is a 5-step procedure. Okay, it is like the business cycle that we go through. We start off with something called introduction. No. Okay, so there's like introduction stage, there's maturity, decline, there is all of these stages, right? But introduction is not the first stage. Now this is one question that they ask very frequently. Introduction you will assume is the first stage. You will have to know these 5 stages in a chronological order. Okay, now and knowing it in a chronological order is very important, because that's the only question that they could ask from life cycle costing. There is nothing else in life cycle costing to know. Understood? So we start off with something called, let me erase this. We start off with something called development. Development is nothing but the research and development phase, R&D phase, research, okay, that we start off with. So before even we introduce, now introduction is not introduction, but introduction of product in the market. Okay, so after you develop the product only, you can introduce the product in the market. Okay, now the moment you introduce it, it will not obviously go down, it will grow first few days. People will be curious about what the new product is, so growth is going to be high for the first few days. Okay, after that it reaches the highest point that it could reach, which is known as the maturity. And obviously after it reaches a high point, that is obvious that it is going to decline. That is life cycle costing. Understood? Now coming to target costing. Target costing goes the other way around. So usually we take the selling price, right? We find out what is the cost, we add how much profit we want, and then we'll determine the selling price. This is the usual way, right? But target costing is the other way around. First you'll figure out how much are customers willing to spend. Okay, looking at that, now customers are willing to spend 8,000 for this pen, let's say. Okay, so 8,000 is going to be your selling price. The second step is you should figure out how much profit you want. Now let's say I want to sell this pen. So customers are ready to buy it for 8,000. I want a profit of 2,000 here. Okay. So how much should my cost be? Obviously 6,000 if I have to achieve the remaining two, right? Because if it goes more than 8,000, no one's gonna buy. If the profit goes less than 2,000, I will not be happy because I wanted to get 2,000, right? So now finally the cost to get to 6,000, we cannot exceed 6,000 if you want a profit of 2,000. Okay, that is target costing going the other way around, not going by cost, profit, and then selling price. Remember in cost card we have total cost, then add a profit, then selling price. But here first find out the selling price and then find out how much profit you want, finally calculate the cost. Now we'll start with ABC, but before we go to ABC, I will take you through the formula for target pricing. Target cost is target selling price minus desired profit margin that we just went through. Maximum allowable cost we need to calculate after finding out how much customers are willing to pay. Now this is the formula for life cycle costing: development, introduction, growth, maturity, and decline. All 5 is written here. Okay. Now, coming to the last part, which is ABC, activity-based costing. First of all, it's a modern method that you need to know. Okay. Now, this is very important because here we will be understanding what activities we are doing and how much we are going to spend. Now, traditionally, guys, we use this traditional costing methods because that time humans were doing most of the work. Machines weren't that very the things weren't automated that time, obviously, like it is now. So labor expenses were calculated in a different way. Machine expenses were very uneasy way, a stupid way to calculate it, because they did not use a lot of machine. But now we need to understand that machines do majority of the work, right? Not the laborers. And when this happens, you should know that because of the machines have fixed cost. Correct. And fixed cost overheads are very, very high because of that. Okay. So different products should be, some cost should be allocated differently in different products. Understood? That's why we have activity based costing. So here we will need to learn a few words, which is overhead, cost pool, cost driver, and allocation. Okay, now this is like this. Let's say to make a cake, okay, 2 people were needed, but the time also was very high, right? But nowadays the same cake can be made by a machine. No person is there here. But will the cost not be there for this? They are assuming that only when laborers are there, in the traditional costing methods, only when laborers are there, cost can be allocated. But here, no person is required, but still machine is required, no? Right? That's why, first of all, we'll need to find out what activity are we doing. Okay, is it a machine doing something? Is it about customer service or anything? It could be, right? After that, you will find out the list of overheads and you will group it together. Okay, so that whole group can be taken together and it will be known as cost pool. Now this cost pool, each cost pool will have something that will increase the cost, right? So that is known as the cost driver. Okay, now using this cost driver, you can allocate to each and every cost pool by dividing it properly. Okay, that is activity based costing. Okay, so these are the 3 words. You can go through, the meaning of it is also written there, right? So with this, we are done with this chapter also. Next, sources of data. Now, sources of data is a completely theory based chapter, right? This one here, we'll just get to know what is a population, what is sample, what are the different types of sampling and all that. Now this chapter is not, I'll tell you which part will come in this. Okay, now you know what a population is, right? A small part of a population will be known as a sample, and sampling risk is because you cannot test each and every sample, there is still a defect default. Okay, there could be defects in some of the products, right? So we'll have to go through the types of sampling. Random sampling, anything you pick up from the population. Systematic sampling, first one will be random and after that you will be going in a sequence of interval. This is also known as quasi-sampling, quasi-random sampling. Okay, now the first one you will pick. So first one you'll be like every 10th cake we will check in a bakery. So now 20th cake you will check next, right? Like this you'll keep going. Next, stratified sampling is you will take a population, you will divide the population into subsections. Each subsection is known as a strata. Okay, and from each of these subsections you will select random people. Okay, now this will be known as stratified sampling. Understood? Next is multi-stage sampling. Here you will select from population, right? Now from that population you will select another part after dividing it. Now from that part you will take another part, that part you will take another part. So every part you will be randomly selecting again. So that is every stage you will be going ahead and selecting. That is multi-stage sampling. Cluster sampling, again similar to all of the above. Will you take a population, divide it into parts called cluster this time. Okay, now from each cluster you will pick one random one. You will not pick everything. Instead, you will choose a few clusters randomly. Understood? And here you will select the whole cluster. In multi-stage, you would have selected one, from that you will select one, from that you will select one, everything goes like that. But in cluster, you will select the whole cluster and go and sample them. Okay. Quota sampling is, there be a fixed quota. Now, if they are doing a sample in a mall, they will tell the group of sample people, they'll be like, I need 10 women and 10 men. So they can randomly pick in any 10 women and 10 men and come. That is quota sampling. Okay. Now, like this, the question will be, you can try to solve this particular question. You can take a screenshot quickly. Okay. Now, types of data. We'll go through this very quickly. We have primary data and secondary data. Primary data is first-hand data. You collect it by yourself. You do not copy it from anyone else. Secondary data is you use something else as a reference and use it. Okay. Next is discrete versus continuous data. Discrete is something that you can count. Continuous is something that you can measure. Now, you cannot go and buy 1.5 eggs. Right, but you can buy 1.5 kgs of chicken, like that. right? So counting, if you can count properly, discrete. If you can measure it in kgs or in time or anything like that, that is continuous data. Okay. Next, nominal versus ordinal data. Nominal is just naming, ordinal is ranking. Now, for example, let's say in blood type, there is nothing that says B positive is more superior than A positive. Correct? It is just naming, we're labeling it, right? But when we are looking at ordinal, customer satisfaction, good, bad, in between, this is better, this is better, and this is not good. Correct? So this is ranking. If you're looking at marks also, 100 marks is better than 0 marks. 100 marks is better than 50 marks. Correct? That is ranking, ordinal data. Okay. Coming to internal and external sources. Internal sources is within the company. External sources of data is outside the company. Okay. Machine data is from the device directly you're collecting. Transactional data is, remember the documents that we went through in chapter number 3, quotations, purchase order, GD and GRN, all that is transactional data. Social data is data from the social media platforms. Could be Facebook, Twitter, Instagram, YouTube, anything, right? Just to understand the customer behavior. Now, one last understanding of these two words, descriptive and inferential. Descriptive is summarized data. Inferential is futuristic data. Descriptive is what already happened. Okay. What happened. Inferential is what could happen. Understood? Inferential, futuristic, descriptive is past data. Now, coming to big data. Big data is like really large amount of data that you cannot store in your WhatsApp messages, cannot store in your spreadsheets, cannot store in notes, anywhere. So for this, they have specific softwares to hold, right? Any company will have big data. They will have to find the list of customers. They'll have to find the list of employees. They'll find a list of new recruits, suppliers, whatnot. There is so much to hold. That's why they use big data. Okay. Now, big data, this is important. The 5 V's of big data. Okay. Volume, variety, velocity, value, and veracity. Volume is how much data is generated. Variety is what types of data is generated. Okay. Velocity is how fast it is generated. Value is it valuable in making business decision? Veracity is it reliable? Okay. During COVID period, you remember how every celebrity were donating a certain amount of money, right? But no one knew exactly how much each one donated, right? But on Instagram, people like to come up with their own assumptions, telling he donated so much, she donated so much and all. Correct? But was it always true? No. I can create an own account and I can start for spreading false rumors like this. Correct? So before you start anything, you should make sure you know it is reliable, it is accurate. Okay, that is veracity. Now, big data analytics is nothing but just examining the big data. Understood? Okay, next we'll come to analyzing data. Now, this whole chapter, we'll just have to calculate and calculate and calculate. There is no meaning that you need to specifically understand. Okay, you know the calculation of mean, median, and mode, right? I will not go through that again. Then you need to know how to calculate the measures of dispersion. Now, first one, mean, median, mode, was the measures of central tendency. Measures of dispersion, we'll be learning what is range, variance. Okay, and then we have standard deviation, coefficient of variation, and then we have normal distribution, right? This is the Z table for it. Okay. Now, range is between so much to so much, just finding a range, highest to lowest values, right? Difference. Variance is, one second. Variance is how much is everything away from the mean. So, if this is the whole thing, mean is in between. If this is where our outcome is, this particular area, how much is the distance? How much is it spread out from the mean? That you will get to know using this formula. And now guys, in this whole chapter, whatever formulas are there, most of it is given in the exam. So you don't have to go ahead and sit and by heart all this, right? So you can see standard deviation formula given. Variance is nothing but square of standard deviation. So whatever formula is here, if you can square this, that means take out the root, you will get the formula for variance. Okay, given again. Okay, next is coefficient of variation. Coefficient of variation means this is the formula, standard deviation by mean. Okay, this is the type of question that will be given. You can easily solve all this, right? Now normal distribution is this particular bell shaped table. What you need to know in this bell shaped table is this whole area which is under this bell, the total should come up to 1. Okay, and in between is the mean. Okay, so obviously if mean is in between, this side it should be, this whole area should be 0.5 and this whole area should be 0.5 because the total is 1 and this is dividing half of it, right? So this is mean. Now why is this area in between bigger than the other side is because usually everything will be around the mean. Now if you're looking at the height of a person, no one will be 1 foot, right? If you're looking at the average age and height, no one will be 1 foot, no one will be 300 foot also, right? Everyone will be around this, some 5 to 6. This is the average. Some people will be 6.1, some people will be 4.3. We don't know. That's why a very small area will be in the corners. This is the place where majority of the people are focused. Okay. Now, for this, we have something called a normal distribution table, which is here. Okay, so this is how we calculate the z-score of each and everything. We will look at the numbers and we will calculate. Okay, it's easy to solve this particular thing. Okay, next, probability is nothing but the likelihood of an event. Now guys, I'm telling you again, calculation I'm not doing, but calculating z is very important here, and you will need to know when to add 0.5, when to deduct 0.5 also. Okay, now probability, the total probability will always be between 0 to 1. So sometimes they'll give you a question and they'll tell in the question which is not a probability. Then they'll give you options like 0.2, 0.5, 1.1, 0.9. Obviously between 0 to 1 is possible, so this is not the answer. Okay, alright. Now probability's formula is number of events divided by number of outcomes, right? So whenever we are rolling a die, okay, we are looking at one event, how many outcomes could come? 6 outcomes. So that is 1 divided by 6. If we are tossing a coin, then what is it? 1 divided by 2, like that. Okay, now coming to expected value. Expected value is if an event is undertaken hundreds and hundreds, so many number of times, what is the final average result that could come? So this is long run average, weighted average, and a option with the highest EV is what we are preferring. So they'll give you 3-4 options and they'll ask you which is what should we choose. Then EV is something that we need to calculate and find out the answer. Okay, like this. See, they've given us so much. What is the expected profit? So you'll do 1000 into 0.3, 3000 into 0.5, like that, and add everything. That will be the answer. Okay, so with this we are done with chapter number 12. Chapter number 11 and chapter number 12 is analytical techniques in budgeting and forecasting, which is a very simple chapter. Okay, in this chapter we will again go through high-low method, which I've already gone through, so I'm not going to go through it once more, guys. Linear regression analysis is just learning one particular formula, which is again given to you in the exam. Regression formula, this one. Okay, to calculate y is equals to a plus bx. Remember this formula that we were going through. Now in this scenario, a and b also you should calculate to be able to get the equation right, but the formula for it is given, so you just need to substitute the numbers. That's it. It is very simple. Time series analysis and index numbers also, there is a calculation for it about last year's and past years will be going through. Okay, now first of all, let's start with this regression, which formula is already given to you. Okay, just use it and substitute it. Now A is intercept, B is slope, like we already learned, right? All this you've already gone through. Correlation, this is an important part. When is it perfectly positive? When is it perfectly negative? Partial, no correlation, etc. Now you need to know again, correlation can only be between 0 to -1 to +1. So if anything is 2, 3 like that, that is not the right correlation. Like how probability can only be between 0 to 1, correlation can only be between -1 to +1. Okay, this is the formula for regression analysis, finding the correlation. Okay, after you find this, formula is already given. Okay, you will just replicate, you will just substitute and write it, and finally if you get -1, then you will tell it is negative correlation, perfect negative correlation. If it is 0, no correlation, like that. Okay, correlation is nothing but how much is one factor affecting the other factor, that's it. Okay, like this, they'll give you the number, you will just have to calculate this and find out what the answer is. Okay, now last one is coefficient of determination, which is nothing but r square. R is correlation, just take the square of it to get the determination. Okay, nothing, they have never asked this particular question, so this is the type of question they'll ask you. Which one is independent, which one is dependent, what is this, what is that, they will ask you, right? Now, time series analysis, you will need to know 4 things: trend, seasonal variation, cyclical variation, and random or irregular variation. Trend is nothing but, in a long term, people usually have a trend, right? It could be upward trend, downward trend, any of this, correct? So this is a long term thing. Okay, so now usually what happens is, right now, let's say people are more interested in becoming, so from the beginning, if you're looking at it, technology is an increasing trend, right? Anything else that is a decreasing, use of internet, increasing trend, correct? Lifeline of people is a decreasing trend. Earlier people used to live for long number of years, but now it's only like within half of it they pass away for some reason, right? Now, coming to seasonal variation, this is nothing but during every season. So, for example, during Christmas season, they go for Christmas trees, they go for cakes, they go for plum cakes, they go for sweaters, winter jackets, all this, right? And during rainy season, they go for umbrellas. During Diwali, they go for crackers. For every season, we have one thing that increases, you'll need to sell it, right? Cyclical variation is like this, guys. Earlier, there used to be a lot of bell-bottom jeans, right? But the trend went away. During the 90s it was there, and then it went away. Skinny jeans came into fashion, and then now it's again bell bottoms, right? So it keeps repeating. That is cyclical variation. Random or irregular variation is out of nowhere, there is something, right? So now when we went through the pandemic recently, right, there was a sudden drop in tourism, right? Because people weren't allowed to travel. How will they come and be tourists here? Correct. So these are the 4 types of components under time series analysis. How will you find the total of it? You can either add it. Y is again nothing but total cost. Add all the 4. Okay. That is called additive model. Multiply all the 4, multiplicative model. Understood? And if they're asking for short term, it is only trend and seasonal variation, not cyclical and random variation. Same thing, simplified multiplicative model is also there. Understood? Now, there's just an explanation of what is trend, what is this and that. Now, this is the regression analysis formula, which is again nothing but y is equals to a plus bx. Okay, just to give again because we had to learn it. Now, moving averages, here it is completely theory. You just need to know the average. Now, they can ask you 2-point average, 3-point average, 2-point average. So, for 3-point average, you will take the total of these 3, 50 plus 54 plus 55 divided by 3. Then you will take 54 plus 55 plus 59 divided by 3. Like this, you will take the total of it, get the average values of each of it and see if it is a decreasing trend or increasing trend. Understood? Seasonal variation, again the same thing. Okay, what we went through. So if you want to find, so that was total cost is S plus Y, right? If you want seasonal variation, T minus Y minus T, like that. Understood? Cyclical variation, the bell-bottom jeans example. Random variation, pandemic example. Right. Now, finally, we go to something called index numbers. Single index numbers, price and quantity we have. Price is P1 by P0 into 100. Price of the current year divided by price of base year divided into 100. Or quantity of the current year, quantity of the base year into 100. This is single item index numbers where only price or only quantity is compared. But then we have something called simple quantity index number, where simple quantity is done. Weighted index numbers, we have two things. One is last year's and one is past year's. Okay, so last year's is something that we are looking of the last year's. Okay, past year's is the current year's. Okay, so when we were doing it, when we were learning it, one of my students gave me this very amazing idea of remembering last year, last. So you can remember it as last year. Past year's is the current year. Right. So now if you're looking at last year's, where is it? Yeah. So last year's and past year's, remember it as last, and this is current. Okay. Now guys, last year's, right, and current years, both we have price index and quantity index under last year's, price index and quantity index under past year's. Okay. Now for price index, what is the general? Okay, let me write it here. Price index and quantity index, right? Let me take the smaller pen. Now for price index, P1 by P0, that is the normal one, correct? But this is last year's. So for quantity, we'll take Q0, Q0. P1 by P1 Q0 divided by P0 Q0 into 100 is the formula. For quantity, it is Q1 by Q0, right? But price will be past years. So P0 into 100. Now, the same thing for current year we'll do. One second. Let me copy and paste the same thing down. Okay. Now, here what we will do is same thing, guys. Okay. Let me actually keep this here so it will be easy to explain. This is current years, correct? So P1 and P0 will be there. But instead of this one, instead of Q0, we'll write Q1 because it is current years. And for the next one, P1. So this is the easiest way to remember all the four. Okay. They will give you the formula. You just need, they will just give you the questions. You need to use the formula and get the answer. This is the type of question they will give. Okay. So in this question, this is 2002, 2003. So this should be past year, correct? So Q0, P0, Q1, P1. And then you can multiply it, get the total of it and calculate last year's, past year's, whatever they're asking. Okay. Now, next is budgeting. Like I said, budgeting is a very important chapter. Okay. I'll tell you quickly what we need to go through, and calculation, what you need to remember, that I will tell you. Right. So now let's start with what is a budget. Budget is a plan that you're expressing either in financial terms or whatever for one specific period you're preparing. So right now you are calculating the budget, preparing the budget. For the next 1 year, you'll probably prepare it. Or for the next 2 years, we don't know. Depending on whatever you want, you will prepare. Right? Now, this particular question is very important. Purpose of budgeting. They will ask you so many theory questions based on this. Even if not so many, one question they will always ask. Out of all the four, which is not a purpose, which is a purpose, like that. Okay. Now, under this, you need to know what is limiting factor. This is very important. Budget committee, budget manual, these three mainly, right? Budget manual is something that involves everything about the budget. Each and everything will be there in budget manual. Now, they'll ask you questions like, they'll give you 4 options and they'll be like, which one is included in budget manual, which one is not. Okay. I'm telling you, if you see the word budget and if you see anything and everything actually is involved in budget manual. Some of these are like organizational chart, budget table, budget plan, everything comes in budget manual. Budget committee is a committee that is set up to form the budget. Now, this usually includes the senior members, right? So obviously the CEO, CFO will be there, the management accountant and all the department health, sales department, marketing department, their heads. Right, all of them will be in the budget committee. Now, finally, limiting factor is something that is stopping you from reaching your maximum limit. Okay, so that is something that restricts you from reaching your maximum limit. You will get questions like, which is the limiting factor in your company? They'll give you a scenario and they'll ask you for that. Okay. Now, this is the budgeting process, guys. Set a mission, find the objectives, get how to reach the objectives. You'll have to find out all of that, alternatives, select the action, short term, monitor it, and then finally, if there is any difference at all, go back and check why it came. Right now, types of budgets, we have different types of budget: functional budget, production budget, all of this. Now this is important, I'll tell you. See, under functional budget, we start with sales budget. This is an important formula for sales budget. How do you calculate the sales budget? Say expected sales units into expected selling price. These formulas. Now guys, budgeting is a very simple chapter if you can remember formulas. Okay, similarly, variance is also very easy if you can remember the formulas. Okay. Now for production budget, this is the formula. If they're asking you for production unit, this is the answer. For material budget, it is divided into material usage budget and material purchase budget. So if they're asking you for usage budget, you will go through this table. If they're asking you for purchase budget, you will go through this table. But if they're asking you for purchase budget, first you'll have to calculate the material usage for it. Understood? Only then you can go for units. Labor budget, this is the formula. Number of hours that you worked into labor rate per hour. Now see, in this number of hours is 8 into 12. That's it. That's the for per unit. Sorry, it's not hours. So 8 into 5.2 or 12 into 5.2. That's the answer. That's it. Overhead budget is whatever basis is there into OAR. OAR we learned how to calculate it in chapter number 5. Overhead absorption rate. Okay, that you need to know how to calculate. Again, if I have to tell you, budgeted OAR's formula is budgeted activity level, budgeted overheads divided by budgeted activity level. Okay. Next, guys, cash budget. Under cash budget, whatever inflows are there added, whatever outflows are there subtracted. That's it. And remember, this year's closing balance will be next year's opening balance. That you need to know. Okay. Then we have these questions. You can look at it, pause it, and try to solve this. Right? If they're asking you for MTQ, this is how they can ask: 2 marks, 2 marks, 1 mark. You can see marks written next to each, right? Now, master budget is something that they used to ask previously, but then now they have made it easy for you. You do not have to calculate any master budget. Okay, so you do not have to make master budget only. You can skip this out of your portions. Okay, but you need to know that master budget includes these 3 things. Okay, income statement is nothing but SOPL, statement of profit and loss, balance sheet is statement of financial positions, and cash flow statement. All these 3 come under master budget. Out of this one you need to know, which is nothing but cash budget. Okay, what is what if analysis? It is for, remember, it is for short term. What is scenario planning? Remember, it is for long term. Okay. Right now, variance, we will learn specifically about it in chapter number 15. So this part I'm going to let it go for now. Okay. Okay, this is important. Feed forward, feedback, and feed forward. Feedback is, giving feedback in the end, correct? Feed forward is just telling it in the beginning. That's it. Okay. Yeah, that's it. With this, we are done with the chapter. It's only consisting of calculations. Now, investment appraisal is a complete calculation type of chapter. Okay, I'll tell you. Here, you will need to solve different questions. Remember the formula for present value. This is just to find out what is the present value of amount if you're looking at it in the future. In the future, if you're going to get 100 after 10 years, how much is the value of that 100 right now? That is what you will find out using present value. Now guys, either you can remember that formula and calculate it, okay, or you can directly get the answer here. Now for example, let's say future 10 years 100 at a rate of 10%. So for present value, I'll have future value is 100 divided by 1 plus rate is 10%, power 10. This is what I need to calculate. But instead of that, I can just go to this table, 10%, 10 years. 0.386 is what I got. Either you can sit and calculate this, or you can just find it out using this table. Okay, and after this, whatever the amount is 100, you will take that 100 and multiply it with 0.386. So 38.6 is the current value of that 100. This is how the present value is going to be. This is very, very essential when you're calculating the other things like NPV and this, right? Now, all this is fine. EIR is another thing that they can ask you. This is the formula, guys. Now you can see this formula is not given to you in the exam. Okay, EIR you will need to know the formula. Okay, 1 plus R by N power N minus 1. Okay, they'll give you what is R, they'll give you what is N. You just need to find out the EIR, effective interest rate. Very simple to calculate. Now, payback period, we have two types, normal and discounted. Okay, now after 10 years, remember I told you the value is 100, correct? But today the value of that is 38.6, right? So if you're taking 100 only as today's value also, that is normal. If you're taking 38.6, that is discounted. That's the difference between payback period normal and discounted. Okay, the formula is very simple. Initial investment by annual cash flow. This they're just asking, our initial investment, let's say, is 1000. Every year you're getting a cash flow of 200. How many years will you take to recover the initial investment? 5 years. That's it. Okay. Coming to discounted payback. Again, you'll need to find the present value of it and then do the normal formula of it. Okay. Use the cumulative method. Cumulative method is nothing but take 100,000 first. Find out what is the present value today. Okay. Today's 100,000 initial investment is today only. So 100,000 is the same. Okay, now annual cash flows is given. Where is it given? This one. Okay, now see, we can try like quickly finishing this. So this is our table, how it is supposed to come. Okay, annual cash flow is given. You will need to find the cumulative cash flow. How are you finding the cumulative cash flow? Initial investment is given 100,000. Okay, same thing. Now second year, what will you do is 100,000 minus, we still need to get 100,000 plus this year you're getting 30,000, remaining 70,000 you need to get. Now after this, next year you're getting 25,000, remaining 45,000. After that 20,000, remaining 25,000, like this. That is cumulative cash flow. Okay. Now what you will do for this is, before you do the cumulative cash flow, you will put in the present value. Okay. So 1 year and how many percentage is it have they given? 10%. Same thing. So what you will go do here is 10% in the present value table, 10% 1 year, 10% 2 years. You will take all the amount, multiply it with these cash flows and get the cumulative cash flow after that and get the answer. Okay, so I'm not doing calculation like I said. So you will need to focus on this, do it. If you have any doubts, comment, guys. We will see. And if you really want this calculation thing, we will see how many people are looking at it and then we will give the marathon for that if it is possible, right? Now, coming to net present value, this is the most important calculation for us. Okay, net present value, we need to find the present value. Okay, now see here, guys. A company invests 100,000 in a project and it is expecting 30,000 for 5 years. Discount rate is 10%. Now, what are we going to do? 100,000 for this current year only, so the present value is also 100,000. Next, 30,000 for year 1, year 2, year 3 till year 5. So 30,000 into 5 years, 10%. So 10 years. So first year 0.952. Second year 0.907. Third year, so like this. Correct. Now that is one way to do it and you'll get the total of it. That will be net present value. But another way to do it is, since we already know it's the same amount, we can just take the total of this 1, 2, 3, 4, 5, 0.952, 0.907, 0. Whatever the total is, that total we will multiply into 30,000. Okay, that will give us the present value directly. This one will reduce the initial investment of 100,000 to get the net present value. Okay, you can use this formula or that formula, whichever is fine. This is gonna be a little more lengthy. This will be easier for you. Okay, if you do not want to sit and calculate the total will already be given here. 5%, 5 years, 4.329. You can check it. If you add 0.95 to 0.907, 0.864, 0.823 and 0.784, it should give you 4.329. Whichever is easy. There are 3 methods. Use whichever it is and you can go ahead. Okay. Same thing for uneven cash flows. We will take this, find the discounting factor 10%, right? So 10%, 0.909826. Whatever it is. No, for year 0 it is 1. From year 1 it is given. For year 0, same amount. 50,000 into 909. I don't know whatever the amount is. Whatever the amount is, take the total of it, guys. That's how you calculate NPV. Okay. If NPV is more than 0, accept the project. If NPV is less than 0, reject the project. Okay. It's that simple. Now, finally, we go through something called IRR. Internal rate of return is the rate at which NPV is 0. Okay. Rate at which NPV is 0. This is how you will find the formula for IRR. You need to remember this. No choice, guys. This will not be given to you in your exam. NPV you need to find for 2 years. 2 percentages. Could be 5%, could be 10%, any 2 percentages. And then you will have to use it in this formula. Okay. Low rate of interest, high rate of interest. If it is low rate of interest, L. 5%. High rate of interest, 10%. Now using that 5%, what was your NPV? Using the 10%, what was your NPV? You'll use all this and calculate the IRR. Okay. Annuity is not required. Perpetuity is nothing but cash flows that you will get forever. Okay. Now, you gave an initial investment of 10,000 for a project, right? After that, every year, you will be getting 2,000 rupees. We don't know for how many years. We'll keep getting it. So, as of now, it is like forever, right? So, how will you do such thing? Cash flow 2,000 divided by rate. Let's say at 2% you're getting. So, 2,000 divided by 2%. 20,000, I think. I don't know, guys. Whatever the answer is, that is going to be your perpetuity. This is how you calculate it. Okay. With this, we are done with investment appraisal. Like I said, that whole chapter is calculation. Sit for 2-3 days, complete each and every question available for that, guys. Okay. It's an easy topic to get marks in, right? Next, we'll go to standard costing. Here, similar to budgeting, we have a lot of formulas. Okay. So if you can remember those formulas, it's going to be very easy to crack this particular chapter, right? So before we start, we will see here, there is like 4 types of cost standard. Okay. Basic, ideal, attainable, and current. Current is currently whatever we are doing, based on that only will cost. Okay. Basic has never changed for an eternity. From the beginning of time, the same standards we are using, and today also we are using the same standards, right? Ideal standards are perfection. Okay. This is if you're living in a delusional world, this works for you. Okay. No one can be perfect. Now, what they're assuming is, guys, employees will come, they will not waste even 1 minute of the time, they'll keep working. Now, that is impossible. As humans, you need to take breaks. Correct. No one can sit and continuously work. Even when you're studying, you cannot continuously work for 10-20 hours. You cannot continuously study, right? You'll have to take these small tea breaks, small coffee, chocolate breaks in between, right? So this is impossible. They are just being delusional. Attainable standards are good standards. These are the best, you can say. Okay. These are standards which you can achieve, which will motivate people to reach that standards. It is hard, but you can do it. Right? Current standards is whatever you're doing right now, keep doing it that later. Okay, this is the laziest standard. Just do what you want. Understood? Okay, guys. Now we'll come to the main part. We are going to be learning about variances. These are the variants that we'll be learning. Okay. So now, variance will be learning for sales variance and cost variance. Cost variance is further divided into material variance, labor variance, variable overhead variance, and fixed overhead variance. Now guys, under sales we have 2 variance, under material 2, labor 2, variable 2, and fixed 2. But under fixed we have something called expenditure variance and volume variance. Okay, volume variance is again divided into capacity and efficiency. Anyway, this is how the whole format is going to look like. Okay, for each of this you have a formula. Okay, you need to remember the formula, there is no choice. Okay, now let's start with sales variance. Sales variance is divided into volume variance and price variance. Okay, now sales volume variance, there are two things you need to remember. One is if the company, see guys, actual quantity, budgeted quantity into standard margin. Now what is standard margin? If you're using absorption costing, standard margin will be the profit. If you're using marginal costing, standard margin will be the contribution. So according to which costing method you're using, the standard margin also differs. Okay, next is price variance. This is only one formula for the price variance. That's it. Understood? And you need to see guys, if actual is less than budget, if actual is more than budgeted, that means your selling price, whatever you sold it for, is more than what you thought you will sell it for. It is obviously profitable for us, correct? Then this will be favorable variance. If it is not profitable for us, it would have been adverse variance. You need to write if it is favorable or adverse. Now, coming to material variance, we have two: material price variance, material usage variance. Okay. Now, there are two ways in which you can do this. Remember this. One is using the formula and one is using a table. Okay. I would suggest remember it using a table. Okay. Because this is much easier to sit and remember. Okay, I will teach you also. See, formula is given here. Now, the formula is like this, guys. We'll have to make 3 rows. 1, 2, and 3. Okay. See, whatever is price variance first line till the minus actual quantity, actual price, that is the first row. After minus actual quantity, standard price, same thing. And this is the same as this one, actual quantity, standard price. And standard quantity, standard price. Okay. Now see here guys. Row 2 minus row 1 will give you price variance. Row 3 minus row 2 will give you usage variance. Price variance plus usage variance will give you total variance. Okay. Now for everything this is the same way. So now since you understood how to look at the formula, I'm just going to go and teach you the table, right? So if you can draw this table, they will ask you what is the price variance. Price variance is nothing but this one, row 2 minus row 1. What is row 2? Actual quantity into standard price minus what is row 1? Actual quantity into actual price. This is the formula for price variance. Coming to usage variance, row 3 minus row 2. What is row 3? Standard quantity into standard price minus what is row 2? Actual quantity into standard price. Got it? This is how we do the material variance, both the price and usage within a table. Similarly, for labor, we have labor rate variance and labor efficiency variance, for which we have formulas. But we also have a table similar to the previous one. Okay. So now, actual hours, actual rate, actual hours, standard rate, standard hours, standard rate. Same thing, row 2 minus 1, rate variance, row 3 minus 2, efficiency variance. Total of rate and efficiency variance is total variance. Understood guys? Now, next is variable overhead variance. Same thing guys, we have expenditure variance and efficiency variance. Formula for each of it and the table for each of it. Okay, same row 2 minus 1, 3 minus 2, and the total of it is this plus this. But there's one scenario. If we are not using we are not using hours and instead we are using output, then the total variance will have a different formula. Okay, that's it. Everything else is same for this and this. Just use the table and you will get the amount for it. Okay, in the exam kit, sometimes what will happen is they'll give you this and they'll tell you to calculate this. They'll give you everything else. Okay, you just need to make the table. Everything else is going to be very simple for you. Okay. Now coming to fixed overhead variance, you can write this down. Fixed overhead variance, first you will decide whether you're using marginal costing or absorption costing. Okay. Now, first of all, under marginal costing, we have only one thing, which is expenditure variance. Expenditure variance is very simple. Actual expenditure minus budgeted expenditure. Understood? That is all with regards to marginal costing. Okay. When we are coming to absorption costing, we have two. One is expenditure and one is volume variance. Now, under expenditure variance is the same as marginal costing, actual expenditure minus budgeted expenditure. Under volume, we have another formula, right? But volume is also subdivided. Let's talk about that later. For now, just understand this part. Understand, guys, marginal costing does not have volume variance. It only has expenditure variance. Whereas absorption costing has both expenditure and volume variance. Understood? Now, expenditure variance, same as marginal costing. Volume variance, it depends if you're using units or hours. Okay. If you're using units, this is going to be your formula. This FOAR is nothing but overhead absorption rate that we've learned how to calculate in chapter number 5. Overhead absorption rate. Okay. Same thing. Here the only difference is if you're using units, actual units, here standard hours for actual production into FOAR, same thing, right? Now guys, that volume is divided into this one. Capacity and efficiency. Now both capacity and efficiency have their own formula. You need to remember it. So for capacity variance, this is our formula. For efficiency variance, this is our formula. Now, whether it is favorable or not, you will need to know learn this particular line to understand that. Understood? Same thing for each and everything, whether it is favorable or not, you will need to learn this. This is all with regards to that. Now guys, sometimes what will happen is they will try to confuse you by asking you, okay, let me show you a question itself. In this question, okay, they've given you all this. Now, calculating fixed overhead absorption rate is nothing but FOAR, which is nothing but OAR basically, guys, which is budgeted overhead divided by budgeted activity level. Budgeted overhead is nothing but 22,960. Budgeted activity level is 6,560. This will give you the answer, right? Now, this is easy. Now, focus. Expenditure variance for marginal costing, expenditure variance for absorption costing. Expenditure variance is the same for both marginal and absorption costing. Okay, just to confuse, they've asked you twice. Now, overhead volume variance for marginal costing. There is no volume variance for marginal costing. You cannot calculate it. This is the way they confuse you. Okay, but volume variance for absorption costing available. Perfect. You can do it, right? Now, they are asking what is the total variance for marginal costing, total variance for absorption costing. Marginal costing total variance, there is only one variance here, the expenditure variance. So, you'll write the total of that. The answer for B will be the answer for F. Okay. Now, for absorption costing, we have expenditure variance and volume variance. So, that is the total of C and the total of E. So, C plus E will give you the answer for G. Okay, this is how fixed overhead variance. Now, fixed overhead is what people find the hardest, but you can see it is very simple once you understand it, right? Now, the final one is operating statements, guys. In operating statements, what we will do is we will start with budgeted and we will end with actual. Okay, from budgeted, favorable we should add, adverse we should subtract to get. So budgeted is X, favorable we will add, adverse we will subtract, and we'll get actual. Now, same thing in absorption also. The only thing is in absorption you take fixed cost and fixed overhead, etc. Here you'll only take variable. I'll give you an example. We'll look at this question, right? They're asking us for actual profit. Budgeted, it should be given. Budgeted profit is 300,000. Then whatever is favorable, 1, 2, 3, you will add 2100, 1800 and 1500. Then you will subtract 1, 2, 3, 4, 5. All these 5 things you will subtract. And finally, you will get the actual profit. This is how you do. The operating statements are very simple. Okay. Now, coming to performance measurement. Performance measurement is a chapter which is mainly dealing with a little bit of ratios, balance scorecard, and not-for-profit organizations. Before we start this chapter, I will teach you the format of any company. Okay, so an organization, okay, could be profit-seeking or not-for-profit organization. Okay, profit-seeking organization are private sector organizations. Not profit sector organization can be divided into NGOs and government organization, which is known as public sector organization. Okay. Under profit seeking, we have sole proprietorship, partnership, and company, limited liability company. Okay. Under limited liability company, again we have public company and private company. Public company is the company whose shares we hold. Private company is the company whose shares everyone, the normal public cannot hold, right? A certain number of individuals can only hold it, right? So this is how the whole organization structure looks like. And we will be looking at what not-for-profit organizations are, what is their motive, what is their goal, what is an organization basically. Okay, organization first starts with a mission. To achieve that mission, it divides it into small objectives, which could be both long term and short term. Then we have something called CSF, critical success factors, which is nothing but these small factors which is going to show us whether we are successful using the objectives. Okay, and finally we have KPIs, key performance indicators, which is the thing that is giving us most performance. Right, now let's go through this first. Performance measurement is nothing but measuring the budget against the target, against the actual result, and seeing if we are going right or not. Okay, then we have profit seeking companies and not for profit sector. Okay, now this is important. See, again, we strategic, tactical, and operational, we've already gone through it, so I'm not going to go through. This is very important. First, I'll take you through this. See, guys, anything we start with mission, objective, CSF, and KPI. What is CSF? CSF are, first of all, they are crucial activities that you must, only if you succeed in this, you can succeed in achieving objectives. Only if you succeed in objectives, you can be okay with the mission. Okay. Now, let's look at this. Okay. This again, responsibility center, cost, revenue, profit, and investment center. Okay. Here, this is important. Triple bottom line reporting. Triple bottom line is nothing but usually financial statements only focus on financials, right? We do not look at the non-financial part of it, only financial, correct? So triple bottom line is something that forces us to look into both financial and non-financial, right? So triple bottom line looks at 3 P's. Okay, one is planet, one is people, okay, and one is profit. Profit is the financial part, planet and people is the non-financial part. Planet is nothing but take care of the planet, take care of all the needs of the planet, don't increase carbon dioxide, don't reduce oxygen, don't cut trees. People is nothing but any person that the company is associated with. Could be your employees, could be customers, could be suppliers, could be shareholders. Each and every employee or people they should treat with respect, that is people. Okay, so these 3 things come under triple bottom line. Understood? Now, CSF, critical success factors, are these essential important areas wherein if they perform well here, only then business will achieve its objectives. Okay. Now, this is the relationship between mission, objective, CSF, and KPIs. Key performance indicators are nothing but they are just monitoring if CSF, which is critical success factors, are achieved or not. Okay. Now, for example, if we are looking at competitiveness is our CSF. Then our KPI will be how much are we growing? What is the size of customer base, etc. If services are CSF, then KPI will be what is the quality of service? How much are the customers rating us, right? Same thing. If you're looking at work-life balance for employees, this comes under planet, correct? I mean, this comes under people, correct? So days they are absent. If they're happy, they will not be absent. Labor turnover means how many people are resigning. If they're happy, they will not resign, correct? Only if you look at all these, you'll realize if the quality of working life, if the satisfaction of employees is good enough, right? So these are the different CSF and KPIs. Now, this is where the important part is. These are the only ratios they can test, okay? You can quickly take a photo of these and just learn the meaning of it. That's it. Okay, just in short, formulas are very important. They will not give you, okay, they'll ask you to calculate, meaning 99% of the time they do not test. Actually, you can forget about the meaning, but in all the future papers you'll have to go through it, so might as well do it right now. Okay, take a picture of all these guys, it is important. Okay, let me show you till receivables collection period first, and then I'll go to the next page. Okay, we'll quickly go through all this. Payable period, capital gearing, return on investment, and the last one is residual income. Okay, these ratios they can test. Understood? Now, controllable profit. Let's look at that. When we were looking at responsibility accounting, we were looking at cost accounting, responsibility, profit, this, that, right? So now, guys, cost manager. Okay. How do you know that this cost manager is doing his job properly or not? Now, there could be two cost managers, A and B. A is living in India, let's say. Okay. In India, you know, the cost of many things is low as compared to living in US. Correct? There, the cost is high. Now, it doesn't make sense if you're going around and giving both of them the same targets for cost cutting. Correct? Now, they'll give us targets like you should reduce $100. Now, it's easy for the person in B who's living in US. Correct? $100 will be nothing for him because he's earning in dollars also. But what about person in India? How can someone reduce $100, which is nothing but 100 into right now 88, 89. So let's take 88. 8,800 he has to reduce. Now we are earning in rupees, correct? So you will have to look specifically for this person. Okay, you will have to look at what the manager can control or not. Currency rates he cannot control, correct? So there are things that manager can control and some things that they cannot control. If they can control it, then only you can judge the person. If you cannot control it, you cannot judge him. Instead, you will give him targets that he can achieve. Okay. For him, if it is $100, you should reduce. For us, it should be something like 500 rupees or 1000 rupees. So it should be better. Correct. So give specific targets like that. So judge a manager only based on controllable. If cannot be controlled, then you cannot judge the performance of his. Right. Now, let's go to non-financial performance indicators. Okay. NFPIs. Now, financial performance you can easily monitor. Just look at the ratios. Just look at how much profit you're getting. Non-financial performance, how do you measure? It's very hard. Correct. That's why we go through something called value for money, which is nothing but the 3 E's. Economy, efficiency, and effectiveness. Now, this is grouped into two main things, productivity and quality. Under productivity, guys, we have these 3 formulas that you need to remember. They will ask you questions regarding these. This whole chapter is based on a lot of ratios, right? Remember these 3 formulas. All this comes under productivity, right? Now, next you have to go to quality. Quality, thankfully, doesn't have any ratios. But remember this. How do you connect these 3 ratios? Like this. Quality is just understanding how is the quality of the product, quality of the service, anything. Correct. Now, how do you measure quality? You need to make sure that you focus on these 4 costs. Prevention cost, appraisal cost, internal failure cost, and external failure cost. You need to know what each of these means. These 2 are known as conformance cost and these 2 are known as non-conformance cost. Okay. What is conformance cost? That is something that is related to the product. This is before you're selling it. Okay. Before you sell the product, Okay, this is conformance. Right now, see, mainly what we are talking about here is prevention cost and appraisal cost is the cost that the business is spending to ensure that business is having, okay, to ensure that the quality is good. Correct. Internal failure and external failure is because the quality was not good. That's why they are incurring these two costs. Understood? To ensure that quality is met, these two costs. To make sure, and since this wasn't ensured, we are incurring the failure costs. Okay, conformance and non-conformance. Now, conformance cost is to prevent the defects. Prevention, right? You're giving machinery for maintenance, you're giving it for repair, etc. Why are you doing that? So that the machine is good. Correct. Only if the machine is good, products can be good. So that is prevention cost. Appraisal cost is something to check the quality. You remember, do you know this ISI, that symbol, however it looks, right? That ISI symbol that you have on gas cylinders and on shoes, etc. This is the quality symbol. Correct. So to get this quality symbol also, you need to pay money. Understood? To test it, to audit it, etc. That is appraisal cost. Internal failure cost is before the sales of the product, you have incurred something. Now, this is like, for example, the customer comes to your shop. Okay, you are sitting in the shop, you're selling her this pen, but when she's writing using this pen, it is not working. Only then you realize that, oh, it's not working, right? Then you will get to know immediately that is internal failure cost. The customer has not bought it yet, she was just checking, correct? And you got to know it is defective. So that is internal failure cost. Now this could have, we have to maybe do some extra work on it, or you can scrap it, anything, correct? But external failure cost is now the customer has already purchased it. After taking it home, after 2-3 days, it stops working. Okay, then she can come back and ask for warranty claim, complaints, etc. Correct? That is external failure cost. Now these four is very important. They will ask you which one is what. They can ask you audits, which one does it come under? Appraisal cost. Like that you should be able to tell. Okay, now this is important, these two words, value engineering and value analysis, guys. What is value analysis? Value analysis is just looking at how the customer is planning to use the product, so we can try to reduce the cost of it in the maximum way without reducing the quality. Now, what I mean by this is, let's say you have some teeth problem, right? So there are cavities on your teeth and you need to get a root canal and this and that, and you need a new cap to cover like a teeth, correct? Now, I cannot go and start making gold or platinum teeth, correct? Diamond teeth, etc. Although, see, gold is malleable, it becomes like this, but diamond is the strongest metal, right? You cannot start using that on your teeth, correct? Because who's going to purchase it? The main purpose is it is hidden, it's in the back, the teeth. Okay, who's going to show diamonds there, right? So you will have to use this normal metal, zirconium or whatever they're using it, right? So we are trying to reduce the cost here, but we are not trying to affect the quality. Zirconium is still a good metal as compared to the normal metal. Also, if you use, you can keep it there, right? Diamond also you can use, but who's going to look at the cost? Who will purchase it, right? That is value analysis. Just understanding how the customer is planning to use. Will the customer buy it? And you will reduce the cost to the maximum level. Value analysis and value engineer is almost the same thing, but value analysis is after the product is produced. You will go ask. Value engineering is even before it is produced as a prevention. Okay, now two more topics under this: balance scorecard and benchmarking. With this, we are done with this main thing. Balance scorecard is similar to triple bottom line. This also looks at how we can look at both financial and non-financial aspects. Okay, so there are four things: customer, financial, IBP, and innovation and learning. Customer is anything related to the customer. Financial is anything related to money. Internal business processes within the business, whatever processes you're doing. Okay, and innovation and learning is research and development, employee training, all this comes under that, right? So go through this particular point. They can ask you questions from each of it, right? Benchmarking is just setting a target and comparing it. Okay, now you can compare it to yourself. I want to be better than myself. Okay, that one is strategic benchmarking. You will compare with the performance of the company in the past and see if you're achieving it or not. Okay. Internal benchmarking is comparing with other departments. Maybe production department 1 is comparing with production department 2. Okay, that type of comparison internally within the company. Okay. Next is something known as competitive benchmarking, which is nothing but compare with your competitors. Okay, now for example, Tata versus Reliance. Like that, you can compare. Right? Functional benchmarking is also comparing with other companies, but they are not your competitors. Now, how can you compare like that? Now, Tata and Amul, can you compare it? Or, okay, Tata Steel and Amul. One is steel, one is milk. How can you compare it? Even though the products are different, but each of these has the same departments, right? This one will have HR department, marketing department. That you can compare and get it right. No, that is functional benchmarking. Got it? This is important. Followed by this also very important benchmarking process. We have planning, analysis, action or implementation and review. They will ask you in a sequence. Okay, which one comes first, which one comes second, like that. You should be able to know. First, for benchmarking, we will plan, we will analyze, we will implement and monitor in the end. Now, service sector, again, we already saw it is intangible, it is this and that. How can you measure the performance of service sector? By looking at how much revenue you're getting, how much staff cost, right? Normal things. Okay. Now, under non-for-profit organization, we went through something called value for money, economy, efficiency, and effectiveness. Now, within this, they'll ask you questions and they'll be like, under which one does it come? I'll give you the example. But before this, you need to write. They'll ask you to calculate also. These calculation ratios are important. Okay. Remember, economy is input, efficiency is process, and effectiveness is output. Okay. See, output. Economy is input, efficiency is the process, and effectiveness is output. Okay. You have to maximize the output using the input, that is effectiveness. Efficiency is within the process, how well you're producing the input, and input is making the cheapest amount. Okay, getting the cheapest one. Right. Now, chapter number 17 and 18 are just for namesake, like I told you. So we'll quickly go through it and then we'll be done with the marathon. Right. Now, I think I took exactly around 3 hours. Right. So we'll finish it quickly. 3.5 hours is what this will go on. We'll finish it. Okay. Email in business. So emails, how do we write? Email will have something called an email signature in the end. Thanks and regards, Naina, like that. Something like that which automatically gets saved. You can do the settings like that in your Gmail or Outlook or whatever and keep it ready. Disclaimer is like this, guys. Whenever you're getting an email from any company or anything, in the end they will tell, if you want to stop listening from us, hearing from us, please send stop. Or using this email is because we are cutting less trees or something or the other disclaimer they have. Okay, any company that is sending. Now, coming to CC, carbon copy, to send it to, send the copy to as many people. BCC is you're still sending the copy to as many people as you want, but no one knows who's getting the copy. Okay. Now, coming to reports. Reports, there are standard and ad hoc, two types of reports. Okay, standard reports and ad hoc reports. Standard reports is the regular report that you normally keep getting, right? Ad hoc report is something for a specific scenario. There's one problem that has arisen. Okay, you need to take care of that problem. That's why we have ad hoc reporting. Okay. Next, key elements of a report. This is what you need to know is, first you will start with list and date. So date, to, from, etc. All this you will write. Okay. Introduction of the report. Introduction. Hello sir, hello ma'am, my name is so and so, right? Sections, what does the report contain, and finally the summary. So with regards to all this, I would like to summarize, right, like that. That is the report. When you're writing your professional paper, guys, you will have to make the report format. All the 4 papers when you're writing, report is mandatory. And just to get the format right, you're getting 5 marks. So this is very important. Okay. Now, In a report, it's always nice for you to have visual representation. Now they can give you diagrams and ask you which chart it is. Okay. And in which scenario, which chart should be used? Bar chart. Component bar chart is used to compare. See, you can see this is dropouts enrolled. For example, dropouts is so much, enrolled is so much. Out of so much that have been enrolled, this many have dropped out. Like that. Okay. Boys. Girls, so many have enrolled, so many have dropped out. Total, it's like this. That is component bar chart. Pie chart is just to show in a 360-degree way what is how much. Okay. Line graph, scatter chart, bar graph. Okay. Multiple bar graph, table looks like this if you don't know, right? So all of these things, they can give you a scenario and be like, which one? Wait, for example, I'll show you. Okay. Report writing, it's not like this. Plan, write, review. That's it. Okay. Now, this is the type they'll ask you guys. A company wants to understand how production cost responds to change in activity level. Which chart will you use? Like this. Okay. So, you will need to use, using this particular question, take this down and try to solve this question. Okay. And finally, guys, coming to spreadsheets. Spreadsheets is like this. I will show you the question. They will give you things like, this is 100, 200, 300. What is the sum of all the three? You write it with the formula. This is H3, H4 and H5, right? So how will you write the sum? H3 plus H4 plus H5. This one way, or you can do sum of H3 range H5. Like this. This is how spreadsheet questions will be asked. This is very simple. Okay, if you know a little bit of Excel, you will be okay with this chapter. Okay, now in this chapter, see, like this they'll ask you. Use addition operate to calculate the sum of this. So you have to write sum B3 is to D3, or you can do B3 plus C3 plus D3. For this one, sum from A4 to A7 is equals to sum A4 range A7. Multiplicator of E3 into 4. Division like this, guys. Just very simple questions. Okay. Now, sometimes they can also give you questions like how do you calculate the average function. They'll give you MCQs. Don't worry about it. You don't have to type. So, when it's average function, average and range. Round function, round it off to round off the number. Okay. Maximum, now there's like this whole, like for example, in this scenario, they'll give you this and they'll ask you what is the maximum. So, you'll do is equals to max H3 to H5 and they'll give you the maximum amount. What is the maximum? 300, like that. Okay. If function, if the box has number less than 100, mark it green, like that. Okay. Next, yeah. So this is all that management accounting is. Like I said, I did not take you through the calculation, guys. If you want it, please comment. We will see if we can provide it, right? Along with that, exam kit questions. Exam kit you need to solve. These are the questions, these are the formulas that will be given to you in the exam. Just keep an eye on this, right? You don't have to go through this. Present value table is there. Annuity table, I would suggest just do not. Normal distribution table is that Z formula. Formula is given, will be given also in the exam. Okay. So these are the things that will be available already. Right, this chapter number 10 and 11, it's completely the small coefficient determination, this that. Chapter number 14 is also completely investment appraisal calculation. So you can go through all this. Simple way to earn marks. Budgeting and standard variances, basically they'll give you, you'll have to just calculate using the formula. You'll need to remember the formula. There's no choice, guys. Okay, so ratios are very important again, compared, like all the chapters are there, ratios. Performance measurement has the most ratios. Go through all that. Okay, so that's it, guys. With this we are done with the marathon. I hope it was informational. Thank you very much for joining. If it helped, I was glad I could. And yeah, you can, you can, if you require something else, please put it in the comments and we will be happy to help you. Okay, all the best. I hope all of you pass. Okay, fine, guys, I'll see you.